Hello, students. Very good evening. Good evening again. So, in the last class, we started assessment procedure, the chapter 15 of my ICAI module. In the last class, we only discussed about the return of income, the concept which we have already studied in IPCC. So today, what we'll do the main part, the assessment part. Okay. But before starting that, let's revise what we did in last class. Just to revise that. Okay. So do revise with me. You know, it will help you in retaining the things. It won't take much time, and be active in the chat box. Do keep messaging so that it keeps your focus on. So what we studied? We studied section 139.1. What does it say? It says two things. What are the two things? Who will tell me? Tell me fast on the live on the chat box. The first thing was who is required to furnish the return of income, and the second thing was tell me. Let's first revise who is required to furnish the return of income. So it says any company or a firm, including LLP or any association, university or college referred to in section 35 or business trust or investment fund. They are required to furnish return of income in all cases without any condition. Remember? Okay. Secondly, any other person is required to furnish return of income when his income without giving effect to chapter 6A means his GTI without giving effect to exemption under section 54 series capital gain exemption exceed the basic exemption limit. Okay, this we studied. So for a firm or a company, return is mandatory in all cases. For others, it is mandatory if the TI exceeds the basic exemption limit. But there are conditions, even if the income is less than the basic exemption limit, still they are required to furnish return of income if they satisfy one of these conditions. What are the conditions? Deposit in current account is more than 1 crore. Deposit in saving account is 50 lakh or more. And then the expenditure on foreign travel is more than 2 lakh. Expenditure on electricity consumption is more than 1 lakh. Then there was a condition of turnover in the business exceeding 60 lakh. Turnover in the profession exceeding 10 lakh. Then the aggregate of TDS and TDS is 25,000 or more and 50,000 in case of senior citizen. Okay. Then we saw, I hope my notes are visible to all of you. Then we saw that in case of individual who is resident and ordinary resident, he is required to furnish return of income even if he doesn't satisfy any of these clauses when if he is a beneficial owner or otherwise the owner of any asset outside India, including financial interest, or he is a beneficiary of such asset, or he is a signing authority of any bank account outside India. Benefit is provided that to a beneficiary if beneficiary of foreign asset, if the income of such asset is includable in the hands of beneficiary owner, then in such case, beneficiary is not required to furnish return of income. Okay. Then there was a definition of beneficiary owner and beneficiary. Beneficiary owner means the one who is paying the consideration directly or indirectly. Beneficiary means the one who derives the benefit from the asset. Okay. So this was 139.1. But it says second thing also. What was the second thing? It provides a time limit for filing the return of income. So firstly, the time limit was 31st October for company or for person whose accounts are required to be audited. And if that person is a firm, then all partners of such firm and spouse of such partner, section 5A applies. Then the due date was 30th November for the person who is required to furnish report under section 92E. Okay, TP certificate. And if such person is a firm, then all partner of such firm and spouse of such partner if section 5A apply. In any other case, it's 31st July. Okay. Then we saw different types of return of income. So we have done 139.1, now 139.3. What 139.3 says is 139.3 says that if assessee doesn't furnish return of income within a due date, then the laws under TGBP, capital gain, and owning and maintaining race laws shall not be allowed to be carried forward. Not set up. It shall not be allowed to be carried forward. You understand all these things. The 139.4 says that if you don't furnish return within the time, then you can furnish by 3 months before the end of assessment year or before completion of assessment, whichever is earlier, we call it belated return. You can revise the return furnished under section 139(1) or 139(4). You can revise that return, but the time limit is same, 3 months before the end of assessment year or completion of assessment, whichever is earlier. Revision can be for bona fide mistake or omission. Then we study 139(9) defective return. If AO finds the return defective, then he will issue an intimation and assessee is required to rectify the defect within 15 days. Assessee may ask for the extension and AO may or may not give the extension. If assessee rectify the defect after the specified period, then AO may condone the delay provided the defect is rectified up to the before the completion of assessment. If defect is not rectified, then it is deemed that return has not been furnished. What are the defects? The column is not filled properly, tax audit report is not submitted, bank account details of manufacturing account, P&L account, balance sheet not submitted, and all this. I told you it's more of a theoretical in nature. Okay. Number is small, 170A, a modified return, not so important. It is filed in case of business reorganization by 6 months from the end of the month in which order of business organization is issued. Okay. So we did this, then what we did the penal consequences in case of return is not furnished by the due date. So one is fee. How much is the fee? Fee is 5,000 or 1,000 as the case may be. 1,000 when the total income is up to rupees 5 lakh. Then there is the interest under section 234A. Then the losses, as I told you, is not allowed to be carried forward. Section 139(3). Then there are some deduction under section 10AA and also chapter 6A, which are allowed only if the return is furnished within due date. So these deduction will not be allowed to the assessee if there is a delay in furnishing return of income. We discuss how we can achieve this through revised return. And lastly, the option to opt out from the default tax regime is available when the return is furnished within the due date. So that option has also gone. Okay. So this we have done. Then we came to the person who are required to furnish return of income even if they are not satisfying the condition 139(1). So who are they? They are charitable religious institution if their income without giving effect to section 11 and 12, without giving effect to the exemption, exceed the basic exemption limit. Or a political party if its income without giving effect to the section 13A, exemption to section 13A, exceed the basic exemption limit. Or entities which are exempt under section 10 if their income without giving section 10 exemption exceed the basic exemption limit. Basic exemption limit for these entities are same as that of individual. Okay. We did this. Then at the same time we also studied who are the person, it's not very important, who are exempted from filing return of income. So they are basically non-resident and foreign company deriving income either from the investment fund in IFSC or specified fund or capital asset referred to in section 47(7)(ab), GDRs, rupee denominated bond derivatives, etc. These persons are not required to obtain PAN as well if they furnish a detail of their address and address in the address of the country of residence, their tax identification number there and declaration. Then we study a small part, a TRP. Who can be a TRP? Is only the individual who is a graduate or an interpass, whether from CA, CS or CMA. And he should not be the employee of the bank or employee of the eligible assessee or a chartered accountant or a lawyer. Who can file the return through TRP? An individual HUF who is resident and who is not required to get his account audited. Okay. Then we study a self-assessment tax. We'll do this in detail through the example in today's class as well. So what is self-assessment tax? The tax which the assessee pays at the time of filing return of income. So how it is computed? Normal tax liability minus any tax already paid plus TDS, TCS, any relief under section 89, 90, 98, 91, any credit for AMT MAT. The remaining amount is a self-assessment tax which you have to pay at the time of filing return of income. Along with this, I pay interest and fee as well as the case may be, if it's applicable. If the amount paid is short of the amount payable, then the amount paid is first adjusted towards fees, then towards interest, and lastly towards the tax. Then we studied what is updated return. Okay, we study one part of it. So updated return is an assessee is allowed to file the updated return up to 4 years from the end of preliminary assessment year. Updated return cannot be revised. A loss return cannot be an updated return. Updated return can be filed whether the original return was filed or not, irrespective of that fact. Okay. But this is for the benefit of government. Therefore, you cannot reduce your tax liability in the updated return, and you cannot increase the refund or claim refund in the updated return. Okay. But if you are reducing the loss, you're converting the loss into an income, then the law requires assessee to mandatorily update the return of subsequent year in which such loss had been adjusted. Okay. Then we saw if the assessment proceeding is even initiated or completed, prosecution proceeding initiated, then you cannot file the updated return. Or if there is the information in the hands of AO which he has received from outside of India under section 90 or 90A, or under the Benami Property Act, Black Money Act, Money Laundering Act, and such information has been communicated to the assessee. Then once the information is communicated, assessee cannot update his return for such assessment year. Okay. Then we study that in case of search, survey, or acquisition, you cannot update your return for such assessment year or any earlier assessment year. And lastly, if one notice under section 148A is issued, we will study this in detail today. And then you cannot file the updated return after 36 months. See, we studied only this much in the last class. It took us around 10 minutes to revise everything. You're with me? It took us only 10 minutes, which we studied for 3 hours. So once we go in detail, we study what was the provision, why it was there, then it helps in understanding, but it only the one-time investment. After in revision, it doesn't take much time. So I request if you people keep on revising a thing, it will stay in your mind and it will create less problem at the time of exam, because the course content is more in income tax and indirect tax and the accounts. So it's better to plan. There is a quote: failing to plan is a planning to fail. So planning should not fail. So we should not be failing in planning. Okay. Okay, students. So my dear friends, today we'll study second part of updated return, practical part. Till now we studied when we file the updated return, when we cannot file the updated return. Anybody can tell me what's the difference between updated return and revised return? In both the returns, I am revising my income. But there are differences. I tell you. See, the time limit for revising return is very limited. Revised return, updated return. We'll do everything in detail. We have a time. So that it helps you in retaining the things. Limited time, which is 9 months from the end of financial year. Here is 4 years. Huge time. But the main difference is that another difference is you can reduce or increase your income. There is no bar, but you can only increase your income. The tax liability cannot be reduced. It is for the benefit of government, updated return. Then thirdly, you can revise the return n number of times. No restriction. But updated return you cannot revise. It's only once. For assessment year, you can file only once. Once there's an opportunity given, and once you file the updated return, then you cannot file another updated return for such assessment year. Yes, Geeta ji. Perfect. And lastly, but the most important difference, I'll tell you. Revised return is filed for a bona fide mistake. They say there is actual genuine error or wrong statement or omission. It's not a malified intention. There was no intention to conceal the income or the tax. But there is no such condition updated return. Rather, generally updated return is filed when the assessee receive a notice from the department that they have some information, and to save himself from the penalty and prosecution, he updates his return. Okay. So the important difference is that under the revised return, I file well to rectify my bona fide mistake. But in updated return, there is no such condition. I can file to rectify the bona fide mistake or not a bona fide mistake. Okay. Now I am on. Okay. So I told you that updated return is not free of cost. Whatever income, whatever additional tax and interest, remember, tax and interest you pay at the time of filing updated return, there is an additional, a percentage of this is called additional tax on such tax and interest. I'll do with the through practical example. So Miss Geeta is asking, when we deposit rupees 1 crore in bank or a cooperative bank current account mandatory for return, but if I deposit it in post office, whether it's applicable. It's applicable only for the bank and the cooperative bank, not for the post office. Okay. Now, so government say if you update your return, then you have to pay some additional tax. What the word used is additional tax. And this additional tax depends upon the time when you update your return. So for the assessment year 26-27, which is the relevant assessment year for my exam, May 26, I can update it return up to 4 years, which comes to 31st March 31. Okay. But government says if you update it within 1 year from the end of relevant assessment year, means by 31st March 28, then you have to pay additional tax of 25%. Okay. If you update it by within 2 years, which means 31st March 29, then I have to pay additional tax up to 50% of what, from 50% off, I'll tell you. Just remember the limits for the time being. If I pay within 3 years, then 10% more, 60%. If I update my return within 4 years, then again 10%, 70%. So depending upon the time when I'm updating my return, I have to pay additional tax. Okay. Where updated return is furnished within a period of 12 months from the end of assessment year. So my assessment year is 26-27. The end is 31st March 27. So within 12 months means 31st March 28. I have to pay 25% as additional tax. It's not called penalty, it's called additional tax. If the updated return filed up to 24 months, then 50%, 36 months, 60%, and 48 months, 70%. You are with me? We can remember this? Of course, sir, we can remember this. 25, 50, 60, 70. Good. If you see, when will one person file the updated return? Of course, he will file only when there is no other alternative to file the return, because there is a additional tax liability in case of updated return. Assuming for 26-27, if I have to update my return, say I got a notice even before 31st December 26. So at that time, if I want to update before this date, I will not file an updated return. I file an revised return or belated return, because there is a time. The time for filing revised and belated return is up to 31st December 26. So in case of revised and belated return, there is no additional tax payable. 25, 50, 60, 70. So why would I file a updated return even before 31st December 26? So the time limit for filing updated return is only from 1st Jan 27. Okay. So if you now see, if I file my updated return from 1st Jan 27 to 31st March 28, it's a period of 15 months, right? I have to pay additional tax of 25%. But subsequently, it's a period of 12 months. You understood why in the first case a period of 15 months? I hope notes are visible. Let me know if not. Why? Because So in the first limb, the time limit starts from 1st Jan and not from the 1st April, because my time limit of filing the belated revised return expires on 31st December. So if I have to file another updated return on 1st Feb in the month of Jan or Feb, I have to file through updated return. There is no other option for me. You know? So in such case, from 1st of Jan 27 to 31st March 28 is 25%. Then from 1st April 28 to 31st March 29 is 50%. 1st April 29 to 31st March 30, 60%. And lastly, 1st April 30 to 31st March 31, 70%. I'm repeating this again and again so that you are able to remember things. Okay, good. Good, Geeta. So it's clear. So it's clear that updated return is not a free of cost return. You have to pay some additional tax. And additional tax depends upon the time when you file the return. Okay, file the updated return. Now this 25% for 50%, 60%, 70% is of which amount? It is of the tax and interest. Tax and interest. Tax and interest. You will remember? Yes, sir, we will remember. It is for the tax and interest paid or payable in the updated return. The tax and interest which you are paying in the updated return, you have to pay additional 25%, 50% or 60, 70% the case may be of such amount. Okay. Actually, what happens when you file an updated return or when you file any return, you need to pay three things. There may be, there may not be, but generally it's the three things. What are they? You have to pay tax. There may be a tax. Then there may be an interest. Then there may be a fee. Fee 234F, 5,000 and 1,000. There are three types of interest: 234A, 234B, or 234. Okay. Generally, an SSC pays either a tax and or interest and or fee. And in case of updated return, there is fourth item as well, which is called additional tax. We'll do it with examples. This additional tax is on the aggregate of this amount, tax and interest. It's not on fees. Understood? The additional tax of 25%, 50%, 60%, 70% is payable on the aggregate of tax and interest being paid in the updated return. So whatever additional tax or interest I am paying in the updated return, I will pay the additional tax as a percentage on such aggregate. Understood? Let me know if you have any doubt. See, if a question is asked from the return of income part of this chapter, that's likely to be from the updated return, either theory question, what we discussed, when an updated return can be filed and when it cannot be filed, or the better question is for at the final level is to ask the student the amount which the assessee is required to pay at the time of filing updated return. We'll do this practically. So you understood? The important part in such question is the amount of additional tax. This is the additional tax. This is the only thing which is paid in the updated return. Only additional thing. So additional tax is on the aggregate of tax and interest. It's not on the fees. Okay. So let's do one question. It will help you in actually understanding the concept of how this additional tax is computed. See, I hope you can see the screen. Let me know if there's some problem in the view. Keep your concepts ready. When I keep the concepts in mind. Yes, sir. Thank you, Geeta ma'am. So there are 5 scenarios: 1, 2, 3, 4, and 5, where we will compute the amount which the assessee is required to pay at the time of filing updated data. Okay. Some common points are there. The relevant previous year 25-26, which is my relevant previous year for my exam as well. Due date of filing return of income is 31st July 26, and assessee has opted for the new regime. Okay. Assume that any amount payable at the time of filing tax return is paid at the time of such filing. If assessee has filed any tax return before updated return, then whatever amount that was payable at that time he has already paid. We will assume that. Okay. Logical assumption. Now, case scenario 1. Try to do with me. Try to apply your mind along with when I'm discussing with you. You can write the answer in your chat box as well. Do ask whatever you want to ask. If there's even a small doubt, do ask. It's important for you to get the concepts clear. We are doing in a great detail so that it helps you in exam. So in case scenario 1, the assessee does not file a original return. So there was no original return. Can an assessee file an updated return even if there is no original return? Yes. So there is no bar. Whether original return is filed or no filed, no relevance. So he files an updated return on 31st March 29. Is it allowed? See, the assessment year is 26, 27. So I am allowed till 4 years, 31st March to 31. I am filing the updated return on 31st March 29. It's after 2 years from the end of the assessment year. So any additional tax which will be payable, it will be payable at the rate of 50%. But in the updated return, I'm disclosing an income of 3,01,000. See, I am following a new regime. In a new regime, the basic assumption limit is 4 lakhs. So there will be no tax, no advance tax, no TDS, no tax liability, and no tax, therefore no interest. There will be no fee. Why no fee? The fee should be rupees 1,000. No. Anybody? Why is there no fee? Attend. Because we discussed fees levied only when the assessee was required to furnish a return of income. His income is only, perfect, Yogesh. His income is less than basic assumption limit, so he is not required to furnish a return of income, therefore no fee. No fee. Everything is zero. So additional tax is what? Is the percentage of this tax plus interest. It's not on fees. But it will be zero. No amount is payable. You are not allowed to furnish return of income, updated return. Because in updated return, there has to be something paid. Okay. Not required to furnish return. Good, Geeta ma'am. Scenario 2. So scenario 1 was simple, vanilla transaction. Even scenario 2 is simple. Here the income is 4,01,000. Everything is same. So again, no tax because I'll be eligible for the rebate. Though I am required to furnish return of income, but the tax liability is nil, and therefore interest liability is nil. But I am required to furnish return of income. Therefore, I have to pay a fee of 1,000, and additional tax will be zero because I told you additional tax is only on the aggregate of tax and interest. It's not on fees, and this is only so that it retains in your mind. So additional tax will be zero. Amount payable at the time of filing updated return is 1,000, and I can file the updated return with the payment of 1,000. Okay. Case 3. Again, I didn't file any original return. The assessee did not file the original return. He filed the updated return on 31st March 28. Means within 1 year. The additional tax shall be 25%. Okay. You are with me? Do ask anything. In the updated return, I offered an income of 49 lakh rupees. Understood? I did not file original return, but I offered an income of 49 lakh in the updated return. Okay. And there was an advance tax also which I paid during the previous year itself of 4,50,000 as on 31st March 26. And TDS was also deducted of rupees 80,000. Still, I opt to not file the original return, but subsequently I felt something or something happened and I filed a updated return 49 lakh rupees. Now, I have to compute the amount which I need to pay at the time of filing updated return. So I need to pay 4 things. One is tax, interest, fees, and additional tax. So let's compute tax. So what is the tax liability on 49 lakh? I am under new regime. So you know the slabs, the new slabs. It's relevant for your exam. It has changed. So up to 24 lakh, there is a tax liability of 3 lakh, 5%, 10, 15, 20, 25. And beyond 24 lakh, 30%. So I am 49 lakh minus 24 lakh into 30% plus 3 lakh, which comes to 10 lakh 50,000. There won't be any surcharge. My income is less than 50 lakh. So cess of 4%, and it comes to 10 lakh 92,000. Hope you are with me. And if there is any problem in computing a tax liability, let me know. We'll do it slab wise. Explain. I hope you understand that. So therefore, we quickly did it. See, the intent of this question is to let you know, to make you understand the how we compute the additional tax. This how to compute the tax, how to compute the interest. You have done this in other chapters. So we'll quickly do that part. We'll focus more on the how to compute the additional tax. So tax is this. I have already paid. How much I have already paid? 450 plus 80. 5,30,000 I have already paid. So at the time of filing updated return, I have to pay the balance, which is 5,62,000. You with me? Then I have not filed the return of income by the due date. The original return has not been filed. So I have to pay the interest under section 234A as well, which is levied if the return of income is not filed by the due date. It is levied at the rate of 1% per month or part of the month. And for how much period? It's for the period starting from the day immediately succeeding the due date up to the date I have filed the return. So my due date was 31st July 26. So interest will be levied from 1st August 26 up to when I'm filing the return. I'm filing the return on 31st March 28. This is 31st March 28. Tell me quickly how many months? So August, September, October, November, December. 5 months for 26, then 12 months for 27, and 3 months for 28, which comes to 20 months. So I'll charge interest at that of 20%, 1% per month. On which amount? On the amount which was not paid, which is 5,62,000. So it comes to 1,12,400. Perfect. Okay. Then there is interest in section 234B. It's levied for not payment or short payment of advance tax. So I did not pay the tax, advance tax. The advance tax was short by 5,62,000. I should have paid the entire tax as advance tax, but I didn't pay. So 1% interest shall be levied, and it is levied from the first day of the assessment year to the date it is paid. So it's levied from 1st April 26 to same 31st March 28. How many months? 24 months. So 5,62,000 into 24%. This comes to 134,880. Perfect. Okay. Then there is 234C. It's levied for delay in or non-payment of advance tax installment. So if you know, see this is, I don't know whether you have covered this chapter or not, advance tax and interest. If you're not covered, don't worry. You will cover in due course, and you will understand all this in like great depth. Today we are focusing on additional tax. So we are just touching upon this point because they are required for my computation. So advance tax is liable to be paid for individual in 4 installments: 15%, 45%, 75%, and 100%. And if it's not paid, then there is an interest liability. So assuming we have already computed the interest liability, 51,106. Assume it is. Okay. So now there will be fee as well, because the original return was not filed and I was required to furnish a return of income. Income is more than 5 lakh, so there's a fee of 5,000. Additional tax. On what amount the additional tax shall be levied? Additional tax shall be levied on 562 plus this 3 interest. I hope you are with me. 5,62,000 plus this 3 interest, and at the rate of 25%. You understood? I have to compute the tax which I am required to pay at the time of updated return, the interest which I am required to pay at the time of filing updated return, and the aggregate of this. I have to pay a 25%, as the case may be, additional tax on the aggregate of this amount. So this is over and above this amount. I have to add all this, and I'll apply 25%. I will get this 2,15,097 as the additional tax. So what is the aggregate amount which I am required to pay at the time of filing updated return is all this plus 5,000 plus this additional tax. This will come to 10,80,043. We can compute as well, but we are not doing it because I'm not sure whether you understand how to compute the interest or not. Okay. And also, we are here focusing on the additional tax. See, case 4, 1, 2, 3 was very vanilla transaction because in all these cases, no originator was filed. This is the most important case 4. If a question is asked in the exam, it's likely to be the case 4 on similar lines. See, here the assessee furnished the original return within time, 31st July 2026. And it showed the income of 34 lakh. Here also 1 lakh was paid as advance tax on the last day of the previous year. No TDS was there. So, what would he have been paid at the time of filing the original return? We have to compute that as well. So, what would he have been paid? He would have paid tax on this, which comes to 6,24,000. Advance tax paid, he would have paid 5,24,000. Okay. There is no 234A. Why no 234A? Because return is filed within time. So no 234A and no fees. Because return is funded within the time. Okay. There is a delay in payment of advance tax by 4 months. You have paid the tax on 31st July. You should have paid during the year itself. So there is that interest under 234B and 234C as well. So at the time of filing original return, the assessee must have paid 5,76,470 as self-assessment tax. Remember, we saw self-assessment tax, how it is computed. The tax liability minus tax already paid or TDS or TCS or credits, and the resultant amount is the tax which I am required to pay at the time of filing return of income, along with interest and all. Okay. So this I must have paid at time of filing return of income. But now on 31st March 29, after 2 years, 50%, I am updating my return and I'm increasing the income by 10 lakh. From 34 lakh, I jumped to 44 lakh. The advance tax was same, no TDS. Now the tax liability is 9,36,000. Out of this tax liability, you have already paid 6,24,000. How? 1 lakh was paid as an advance tax. This as advance tax. And as self-assessment tax, I paid 5,76,000. Okay. So in this 5,76,000, there are three things. One is tax of 5,24,000. Then interest of 20,960 under section 254B. Then interest under section 234C of 31,512. So the additional tax which I am required to pay at the time of filing updated return is 936 minus 1 lakh minus 5,24,000. Means 9,36,000 minus 6,24,000 is comes to 3,12,000. You have with me? And in doubt, let me know. No to 34A. Why? Because original return was filed within time. The 234B shall be computed in reference to the new income which I am disclosing in the updated return. It will become 2 rupees 1,33,280. It will be computed in two parts. First, on the liability was 9,36,000 tax, advance tax was 1 lakh. So on 8,36,000 for 4 months up to July 26, and then in July I further paid 5,24,000. So on the balance 3,12,000 from 1st August up to 31st March 29. So this is how 234B is computed. It will be computed in parts because during the period I have paid something. So till that time I have not paid anything for the gross amount, entire amount. Once I have paid something, then on the net amount for the subsequent period. Once I have paid, then why will the government go in charge interest on such amount? Understood? See, I was required to pay 9,36,000 as advance tax. I paid only 1 lakh as advance tax. So on there's a default of 8,36,000, but default of 8,36,000 only for the 4 month, because on 31st July I paid 5,24,000. So now on 1st August the tax which was due was only 3,12,000. 836 minus 524. Okay. So for 4 months, interest will be charged on this amount, 836. And for subsequent period, interest will be charged on the remaining amount, 3,12,000, which was due. And it's logical as well. So interest comes to rupees 1,33,000. But I have already paid the interest at the time of filing original return of 20,000. So I need to pay on the balance interest with the updated return, which is 1,12,000. Similarly, I will do the same exercise for 234C. It's not in different parts, it's only doing the previous year. So 234C comes to 47,268. I have already paid 31,512. So remaining I have to pay at the time of filing updated return. There is no fee. The return was filed, original return was filed within time, but there would be an additional tax. And additional tax would be on the tax which I am paying on with the updated return plus interest which I am paying with the updated return. So 3,12,000 plus 1,12,320 plus 15,756. This or an additional shall be the 50% of aggregate of this amount. Okay, so this comes to 2,20,38, 2,02,038 rupees, and aggregate amount which I am required to pay at the time of filing updated return is 660,114. It's just the aggregate of all this amount. If a question is asked, what would the question? Question would be the assessee furnished return of income by the due date and it shows an income of 34 lakh. There was a advance tax payment of 1 lakh. Then he will say that whatever the tax was due at the time of filing original return, he paid that. He will not give you the figure of 576. He will just say whatever tax was payable, he already paid. Then he will say that the assessee updated his return on 31st March 29 and the updated income was 44 lakh. Compute the amount which the assessee is required to pay at the time of filing updated return. So the answer is 660. But to come to this answer, first you have to compute the amount which the assessee must have paid at the time of original return, 576. And then you can compute the amount of tax, interest, which he paid at the time of filing updated return, and the additional tax, and then aggregate. So in this way, the amount which is required to be paid updated return is computed. If it's something heavy for you, try to view it 1 or 2 or more times, or if you want me to repeat something, do ask me. I'll explain again, anything. The problem might be because you may not have studied the computation of interest. Otherwise, the updated return says only one thing, is that the additional tax has to be 25%, 50%, 60%, 70% of the aggregate amount of the tax and interest which you are paying at the time of filing updated return. Only this thing. How you compute the interest? It's not in 139A. It's in 234A, B, C. In the different chapter. The case number 5 is similar to case number 4, the assessee filed original return with the same figures. But in the updated return, the assessee shows the income of 44 lakh. There was advance tax of 1 lakh. But with the additional income, there was an additional TDS as well, which assessee wants to claim. Assessee wants to claim 7 lakh as additional TDS. Tell me, is it allowed to claim an additional TDS at the time of filing updated return? I tell you. See, the law doesn't stop me, but law says one thing: you cannot decrease your tax liability or you cannot increase your refund in the updated return. So long as there is something payable in the updated return, comment is fine. You can claim the additional TDS if you have not claimed it in the original return, but such additional TDS should not result in the decrease in tax liability or increase of your refund. So in this case, my tax liability becomes 9,36,000, but I have already paid 13,24,000 because 1 lakh was an advanced tax, then 7 lakh is a TDS, it comes to 8 lakh, and 5 lakh 24,000 as part of self-assessment tax. So it comes to 13 lakh 24,000. Though my liability is 9 lakh 36,000. So there's a refund of 3 lakh 88,000 on account of tax itself. Then there's a refund on account of 234B also, because I have already paid higher 234B, which I was not required because I had a TDS. Similarly, I have already paid higher 234C, which was not applicable, which was I was not required. Okay. So overall, at the time of filing updated return, of course, in such case, there is no additional tax because there is no tax or interest. There is a refund of 4,23,000. And in such case, updated return is not allowed. Updated return is only for the benefit of government. You cannot claim refund in the updated return. Understood? I hope I'm clear. Keep the class interactive. It will help you to stay focused. Thank you, Geeta ji. Geeta ma'am is always active. Thank you. So, let's read what the provision says, which we have already discussed. Now it will be very easy for you to read. Assessor shall be liable to pay the following before filing the updated return. Self-assessment tax as computed below. We will see how it's computed. Interest, fees, and additional tax. Now you know the important part is additional tax, and it's a percentage of this tax and interest. 25%, 50%, 60%, 70%. Okay. So how this tax is computed? You will compute the tax on the income declared in the updated return, which we did. You will add 234A, 234B, C, or a fee. What you will reduce? You reduce advance tax already paid, TS already paid, any credits, self-assessment tax, or interest paid in earlier year. We have seen the practically how it's done. Okay. And if any refund has already been issued to you in your original return, that you have to revert back, pay it back. It has also be added. And the resultant amount is the self-assessment tax. This plus the additional interest which you are paying shall, means if this is 1 and this is 2, then this self-assessment tax plus 1 minus 2. This is the additional interest you are paying 1 minus 2. And you have to aggregate these amounts, and you will apply the 25%, 50%, 60 or 70%, the case may be, as a percentage of additional tax. Sir, only calculation 24B C interest, I don't know how to calculate, otherwise everything is clear. Thank you, ma'am. I apprehend this because maybe you have not covered that interest chapter. Once you did it, it will be very much clear. Even if it's not very much clear, let me know. I'm always there. Okay. So we skip this part. 25% of self-assessment tax payable under 140B and interest. Okay. If you remember, when we study defective return, so one of the reasons by which a return can be defective is if the challan of tax of 140B is not paid at the time of filing updated return. But similar thing was not there in case of original return. Say, in this example, the assessee was required to pay original tax of rupees 5,76,470 at the time of filing original return. And he is required to pay 6,60,114 at the time of filing updated return. If he filed the original return without paying this tax, showing it as a tax due, then return will not be defective. Okay. But if he files the updated return showing this tax as due, not paying this tax, then your updated return will be defective. Okay. We are covering small point as well because I don't know what the examiner may ask. So there may be a MCQ or something on this. Now, small parts. Who shall sign the return? So who is authorized to sign the return? If there is an individual, of course, it's very logical. You will find it very, very logical. And see, in exam, you have to attempt 100 marks of paper. See, remember this thing. Even in the tax paper, if the question comes from a chemistry chapter or from a biology or from mathematics or whatever, I mean to say, if a question comes from a topic which you have not even listened one, if you not even studied anything, don't know anything about that question, still you have to attempt that question. This is the funda of attempting the how you attempt the exam. You cannot leave question. You have to attempt the question paper for 100 marks, whether you know or you don't know. The question comes, if you don't know the answer of a question, how will you attempt it? You will attempt it based on your logics. See, the text, the law, rather the law is only based on the logic. If you're reading some provision and if it's not logical, then more likely than not, your interpretation of provision may not be the right. Understanding of provision may not be the right, or you may not know the background why this provision came. Otherwise, we'll find every provision as a logic. Okay. So if some question comes which you don't know, then apply your logic. Say something comes in the text and you don't know. Assume yourself as a finance minister. Had you been the finance minister, what law you would have made for this situation? And write the answer. I'm telling you, it will help you in scoring good marks, because leaving the question means you forgone the entire mark. If you try to attempt, there's a stepwise marking in ICAI. You will get at least 1.5, 2 marks in that question. And even the half marks makes a lot of difference. Makes a lot of difference in the aggregate. I'm telling you. Okay. So come back to the subject. Who shall sign the return? Who is authorized to sign the return? So in case of individual, of course, individual himself will sign the return. If he is absent from India, then also he will sign the return, or he may give a power of attorney to any person. The power of attorney is generally it has to be the specific power of attorney authorizing that person to sign on his behalf. If he is mentally incapacitated, then his guardian or any other person who is competent to act on his behalf shall sign. If for any other reason he is not able to sign, then he will authorize somebody, the specific power of attorney, for signing the return of income. HUF. The return of HUF has to be signed by the Karta. If Karta is not able to sign, then any adult member, of course, a minor cannot sign. It's all logical. You find everything logical. In the partnership firm, the managing partner shall sign. If there is no managing partner or managing partner is not able to sign, then any adult partner, not being minor. Same goes with the LLP. There is a designated partner. If there is no designated partner is not able to sign, then any other partner. Any partner thereof. Okay. In case of company, the MD. If the company is Indian company, then the MD. If there is no MD, then any director. Okay. We'll cover this part in a minute. So you understood? In case of individual, he will sign. If he's not there, he is not able to sign, then any person who is authorized by him. Okay. HUF Karta or any other adult member. Partnership LLP, the managing or designated partner. Otherwise, any adult partner. Company MD, if there is no MD, then any other director of the company can sign. Okay. But if there's a non-resident company, then either the MD will sign or a person holding right power of attorney from such company. Generally, what does the foreign company do? They give a power of attorney to their Indian consultant, the chartered accountant or the lawyer who are professionals is handling the Indian compliances, Indian income tax compliances. They give the power of attorney in the name of such person and such person sign. See, the important difference is that if the company is NR, then there is an option that a person holding power of attorney can sign. A person holding right power of attorney can sign. But if there is a company is not NR, Indian company, then the return has to be signed by either MD or a director. There is no option that the director give a power of attorney to somebody. Okay. If company is into liquidation, then a liquidator sign. And similarly, if company is liquidation, then there is resolution professional, interim resolution professional, resolution professional, liquidator can sign. Well, these are persons who are appointed by the NCLT. Okay? If company is liquidation, of course, the director is not able to sign. So this person who takes care, who now take over the affairs of the company, he shall sign. Company whose management has been taken off the government, then principal officer shall sign. Company whose application has been admitted under insolvency code, then the IP, insolvency professional shall sign. Local authority, principal officer, political party, chief executive officer, any other person, president, complete to verify. So very logical, simple, not so much important from exam point. Then we are left with the two small topic, not so small topic, but not too much important from exam point of view. One is PAN and another is Aadhaar. So my act requires that every person obtains a PAN. See, the PAN is my identity for income tax. Tarun Gupta is not an identity of me. Income tax know me by my PAN, not by my name. There may be many Tarun Gupta, but my PAN number is unique. So income tax identifies me by my PAN number. So it says that every person is required to have a PAN. So first thing is, in this topic we will see the two things. One, who is required to obtain a PAN, and secondly, in what all document this PAN is required to be stated. Okay. So firstly, following person are mandatory required to obtain PAN, and also gives the date by which the PAN should be obtained. So first is on or before 31st May, whose income exceeds the basic assumption limit. Logical. Any resident person who enter into a financial transaction of 25 lakh, 2,50,000 or more in a financial year. If any resident person, the person may be a company, firm, individual, whatever, if he enters into a financial transaction of 2,50,000 or more, then he has to mandatorily obtain a PAN by 31st May of the following financial year. Or if such person is not an individual, is a company, firm, HFM, then all managing director, partner, trustee, author, founder, karta, CEO, principal officer, office bearer of such person has to obtain PAN. Such person has to be resident. And this clause 3 need not to be resident. Understood? If the company is resident and company has to obtain PAN, then his director, even if non-resident, has to obtain PAN. If his total turnover, in this case, the PAN has to be obtained by the end of financial year. If total turnover exceeds 5 lakh, small amount, or he is required to furnish return of income under section 139 4A. 4A is charitable and religious trust. Okay. In these two cases, you have to obtain PAN within 7 days of the event. And what are the cases? If you deposit or withdraw cash of 20 lakh or more in your account, or you intend to open a current account. Further, central government may say to any person, you go and obtain a PAN. Rather, AO, tax officer, may himself allot PAN to any person. Also, even if you're not coming under this clauses, you can voluntarily apply for the PAN. And there is no condition that it has to be under this clause. You have to satisfy this clause to obtain a PAN. You can voluntarily apply your PAN. What I remember is, in India, the youngest person who has PAN is a child of 7 days old. 7 days. Okay. You can, of course, voluntarily apply your PAN. Now we come to the quoting of PAN. The documents where the PAN is quoted. It's very logical. Of course, in all your correspondence with the income tax department, you have to quote PAN because income tax department doesn't know you, doesn't know the Tarun Gupta. Who knows him? He knows who? He knows the PAN, the PAN number. So in all correspondence, when you open a bank account or a demat account, we are doing it in faster because not much relevant from your exam point of view. When you're applying for a credit or debit card, if you purchase or sale motor vehicle, irrespective of the value, you have to apply for that. You have to quote your PAN. If you sell or purchase securities, not a listed one or unlisted shares for an amount of rupees 1 lakh or more per transaction, then you have to apply. You have to state the PAN. In case of sale or purchase of property of exceeding rupees 10 lakh, then you have to state your PAN. Single payment in cash. So if you pay in one transaction cash payment to a hotel or for a foreign travel of an amount exceeding 50,000, then you have to quote your PAN. So if you go for a vacation and you pay to the hotel in cash of more than 50,000, then the hotel manager would ask the PAN from you. Definitely. If you purchase mutual fund of exceeding 50,000 rupees, not necessarily in cash, or debenture or bonds of the company of exceeding 50,000, then you need to state the PAN. Cash deposit exceeding 50,000 in a bank during a day, then the 2 points, the cash withdrawal or deposit of 20 lakh or more, or you open a current account, you have to state your PAN. If you pay cash exceeding 50,000 on any day for purchase of bank draft, if you get your time deposit means FD or RD, of amount exceeding 50,000 or 5 lakh in a financial year. Payment of amount getting more than 50,000 financial year for LIC, life insurance premium, you are paying a more than 50,000 of life insurance premium, whether in cash or otherwise, you are required to state the PAN. This is important. Sale and purchase of any goods or service of exceeding rupees 2 lakh per transaction. If you enter into a transaction, you are making a payment of more than 2 lakh, then the recipient will ask for the PAN. In case of TDS or TCS, of course, otherwise credit shall not be allowed. Every person deducting collecting tax shall quote PAN of deductive collected in the certificate issued and return furnished in this regard. So the deductor has to quote the PAN of the deductee and in the TDS certificate and in the tax return, TDS return, which is filed with the government. And this is very important because otherwise, how the credit of tax deducted shall be allowed to the deductee. Understood now? If you pay me something and you deduct my tax, that tax is my income, is my money with the government, which you have deposited on my behalf. How will you say that it's on behalf of Tarun? You will say it by quoting my PAN. You quote my PAN in the TDS return. Only then it gets reflected in my 26AS form. Quoting of PAN is not required by the government or non-resident. And there is an option of interchange. If you don't have a PAN, you can quote your Aadhaar as such. But in such case, you don't have a PAN and you quote your Aadhaar, it shall be deemed that you have applied for the PAN. And tax department shall issue you a PAN. Any of the default, if you made in respect of PAN, you don't obtain a PAN number or you don't quote it in the document whichever is required, then there is a penalty of 10,000 per default. Now we come to the Aadhaar. 139AA. Every person who is eligible to obtain Aadhaar shall quote Aadhaar in an application for allotment of PAN in the return of income. See, this is the master stroke of the BJP government. They came out with the Aadhaar. And what they did is, they did a drive by linking your Aadhaar to the PAN. And now, even entire bank account, entire financial economy of the India, either the PAN is linked with every transaction or the Aadhaar is linked. And PAN and Aadhaar in itself are linked. So that's why the government knows everything about every financial transaction you have undertaken. The government is aware about it. This is for the flow of information. Information is the king. They have a lot of information which we can think of. They have more than what we think they have. And now they can process it and use it the way they want. This is happening in income tax. Now the forms are pre-filled. The government pre-fills the income of the assessee in the form. How the government gets to know the income of each assessee? There are crores of assessee, and the exact income government knows. How they know? Through the linking of PAN and Aadhaar. Now they have track of all the financial transactions which we are doing. Okay. So earlier, what was happening? There was an option that if you don't have an Aadhaar, you can put your Aadhaar enrollment ID. What's an Aadhaar enrollment ID is that unless till the time Aadhaar is issued, if you have applied for Aadhaar, so Aadhaar gives you enrollment ID. After some time, it gives you Aadhaar number. So now this option has been taken away. If you only quoted your enrollment ID, then on or before 31st December 25, you have to state your Aadhaar number as well. Every person who has been allotted PAN before 1st October 24 on the basis of Aadhaar enrollment ID shall intimate his Aadhaar number on or before 31st December 25 for such date as may specified by the CPT. This is because if you have not linked your Aadhaar to the PAN, then there will be a gap and government may not be able to get the all financial transaction about you. So what people were doing, they only quoted Aadhaar enrollment ID with the pen, and by this way, they try to hide their transaction. But now, because of a very short-lived option, now government said that no more enrollment ID, you have to quote your Aadhaar. See, here's the linking come. Every person who has been allotted PAN and who is eligible to obtain Aadhaar shall link his PAN with Aadhaar by 31st March 2022. So they did a great drive. They're doing this from 2022, and almost now everything is all PANs and Aadhaars are linked. If it's not linked with Aadhaar, the following consequences shall apply. See the consequences. There's a penalty of 234H. Okay. PAN shall made inoperative. It will be deemed that your PAN is inoperative. It has very great consequences. I tell you the consequences. The TDS, which is to be deducted, shall be deducted at a higher rate. You have studied under the chapter of TDS and TCS. So if TDS is to be deducted on my income or TCS to be collected from me, then such TDS and TCS shall be deducted or collected at the higher rates. Okay. No refund shall be issued to me. And if there is any refund, if there is any interest on such refund, no interest during the period my PAN remain inoperative shall be payable to me. These all the. So no refund shall be issued, no interest will be payable on such refund. Tax shall be deducted or collected at a higher rate. But once you link the PAN and Aadhaar, then the PAN becomes operative within 30 days. And there is a provision that higher rate of TDS shall not apply in the following cases. What are the following cases? That where the amount is paid or credited from 1st July 24 to 31st July 25 and PAN is made operative on or before 30 September 25. If PAN is made operative before 30th September, then the higher TDS or TDS rate shall not apply. And where the amount is paid after 1st August and PAN made operative within 2 months from the end of the month, the amount is paid, then the higher TDS and TCS rate is not applicable. I hope I'm clear. We are doing it very fast because it's not much relevant. PAN, once made inoperative, become operative in 30 days from the date of intimation of Aadhaar number. From the date of intimation of Aadhaar number means from the date of linking with the PAN. This is the penalty on 234H. It was 500 up to 30 June 2022, and then after that it's 1,000. So if you now link a PAN with Aadhaar, you have to pay rupees 1,000. Lastly, these 4 types of people are not required to obtain Aadhaar in the Aadhaar Act. Whatever law requires people to obtain Aadhaar, exempt these 4 types of people from the requirement to obtain Aadhaar. And therefore, these penal consequence of not linking the PAN with Aadhaar doesn't apply to them. Consequently, once they are not required to obtain Aadhaar, then how can they link it with the PAN, the thing which they don't have? So any person who is adding Assam, J&K and Meghalaya, even if they don't link the PAN with Aadhaar, no consequence. Any non-resident, he is not required to obtain Aadhaar. Any person of the age of 80 years or more at any time during the previous year. Any person who is not a citizen of India. So these 4 types of people are not required to obtain Aadhaar, and therefore the linking of PAN and Aadhaar is not mandatory in the case of these persons. Okay, friends. So this complete my chapter return of income. Okay, it's one part of my assessment procedure. Now I'll start my another part and the most important part from exam point of view, the actual assessments. Okay, but before that, let me discuss with you the procedure which happens, the assessment procedure which generally happens. What happens is that assessee files return of income. Such return of income is mandatorily processed under section 143(1). So whatever return we file gets processed. This is purely computerized, no human intervention. No computer does it. Then 1 or 2% of returns are picked up for assessments. What do you mean by assessment? If the tax officer checks the accuracy of the return of income furnished by you. Then he passes an assessment order. The assessment order may be that he finds everything fine, no addition, nothing. The return income is accepted, or he may do some addition. If assessment order is not in your favor, then you can go into appeal. The levels of appeals are different. CIT appeal is the first level of appeal, Commission of Income Tax appeal, then Income Tax Appellate Tribunal, then High Court, then Supreme Court. In this chapter, we are dealing with the assessment. Well, these points are relevant for me, but we are not going detail into the appeal procedure. Okay, in this chapter, you do it subsequently. Okay. There are two more things. So what we discussed till now, return of income, then that return of income is processed, then there is an assessment, may or may not be an assessment, and after assessment there is an appeal. But in between there are two more things, which is rectification and revision. So what is rectification and what is revision? Rectification is if there is some mistake apparent from record, very basic mistake, then the assessee or the department can rectify that. Okay. The mistake may be in the return of income, maybe in the order, maybe anything. Okay. So both the parties can rectify that. Revision is, see, if the AO has done the assessment, then the commissioner, his boss, may find the assessment has not been done the way it should have been done. So it has resulted in a loss to the revenue. Revenue means loss to the government. So he may ask the AO to revise the order. This is revision against the assessee. Similar way, when an assessment order is passed, the assessee has two options. Either he can go for the appeal or he can go for the revision. The options are mutually exclusive. You cannot go for the both. You have to opt for either of the one. When you studied these in detail, you will understand they have provision to take care of this. So whenever an assessment order is passed, an assessee has an option to either go for the revision or go for the appeal. There are consideration points by which you will be able to judge whether you should go for the revision or appeal. So there are pros and cons for both the options. Okay. You as a CA have to evaluate whether to go for the revision or an appeal. Okay. Treat yourself as a CA. Act like a CA. I treat you guys as a CA. Okay, you have already become a CA for me. So behave professionally and work professionally. Okay. So this was a small procedure which is followed in income tax. So I file return, then return is processed mandatorily. It may come into assessment, it may not come into assessment. Then after assessment, there either will be appeal or revision, or I'll accept the assessment order. An appeal can be, the form of appeals are CIT appeal, then if I'm not satisfied, ITAT, High Court, Supreme Court. Okay. So in all this appeal, even assessee can appeal or the department may appeal. The CIT appeal may give a relief and department may not be happy with it. Though he is a person of department, but department may not be happy with it. The department may file an appeal to the ICAI. Similarly, ICAI may give a relief and department will go for the High Court. She is similar to the Supreme Court. And it applies to the assessee as well. Assessee can file an appeal to CIT appeal against the assessment order. He can file an appeal to the ITAT against the order passed by CIT appeal. He can file an appeal before the High Court against the order passed by ITAT. And similarly to the Supreme Court. Any doubt till now? Okay. Now we are doing some important thing. Now focus, everybody focus. We'll do the assessment part. Today we'll cover most of the assessment, except the assessment in case of search cases, which we'll do in the next class. First section is section 142.1. It's not an assessment. It's only an inquiry. So my assessments are four types of assessment. One is 143C, scrutiny assessment. We'll discuss in detail. 144, best judgment assessment. 147, income escaping assessment. And 153, the search assessment. Okay. 142.1. What's 142.1 says? It gives a power to tax officer to issue a notice for any inquiry. What type of inquiry? He may ask the assessee to furnish return of income if the assessee has not furnished it by the due date, and or he may ask for some information from the assessee. Okay. So you may issue a notice to any person who has furnished ROI or in whose case time allowed under section 139(1) has expired, requiring him to furnish ROI if ROI has not been furnished. So if a person has not furnished the ROI, return of income, the AO may issue a notice to him asking him to furnish the ROI. Tell me, when will the AO issue the notice? Of course, AO will issue the notice only after the due date. Okay. See, example. So Mr. A is not required to furnish an ROI under section 139. So it doesn't come under any of the provisions of section 139. He is not required to furnish. Take an example of yourself. If you don't have any income, then you are not required to furnish ROI. Okay. But a notice is issued or served on you asking you to furnish an ROI under section 142(1). So, are you required to furnish an ROI or not? But in such case, if a notice has been issued, and even if the assessee is not required to furnish ROI, he has to furnish the ROI. But such notice will be issued only after the due date. Because we, of course, wait up till the due date, the assessee may have filed. When the due date has passed, he can issue a notice asking assessee to furnish a return of income under section 142(1). Another type of information he may ask under this notice is he may ask the information or the account from the assessor. He may ask assessor to produce such accounts or document as he may require, or to furnish such other information as the AO may require. And such information may include statement of assets and liability of the assessee, whether included in the accounts or not. What do you mean by whether included in the accounts or not? Wherever you have any doubt, wherever you don't able to understand, you don't know the meaning, of a phrase of a word, let me know. Okay. Whether included in the accounts means if you are doing a business, then you must be preparing a P&L account and balance sheet. So there would be assets and liability. But if you are salary class, then you are not preparing your balance sheet. Of course, you don't have a business, then you are not preparing your balance sheet. Or even if you are doing a business and offering income on presumptive basis, then you are not preparing your balance sheet. In such case as well, the AO may ask you to submit the balance sheet. Okay. But if balance sheet is not part of your accounts, then he has to obtain the approval of Joint Commissioner, JC, his boss, before requiring assessor to furnish statement of asset and liability not included in account. So you are with me? If an assessee has not furnished return of income, AO may issue a notice asking him to furnish return of income. Okay. If whether assessee has furnished return of income or not, AO may issue a notice asking him to furnish such information on detail as he may require. AO may ask to furnish a statement of assets and liability, whether such assets and liability are included in the account or not. But if it's not included, then AO has to obtain the prior approval of Joint Commissioner before asking the assessee to furnish the statement of asset and liability. Also, for the accounts, you cannot ask the accounts relating to period more than 3 years prior to the relevant previous year. Cannot be asked. AO cannot go beyond 3 years. He has to limit up to 3 years. Okay. For the purpose of obtaining full information in respect of income or loss of any person, AO may make such inquiry as he considers necessary. He may ask anything from you by way of notice under section 142(1). But remember, it's not the initial assessment. It's only a query notice. Sorry. It's only an inquiry notice. See, there are implications when an assessment notice comes. I tell you. Once an assessment notice comes, you cannot update your return. Remember, on the initiation of assessment, you cannot update your return. So, but this 142(1) is not an assessment notice. Even it has come, you can update your return. Okay. It's only an inquiry, which may result into an start of initiation of assessment. So note in the section 142, either to furnish a return of income, if return is not furnished, to produce the cost to produce accounts or document, but accounts prior to 3 years cannot be asked, or to furnish a statement of assets and liability. But if that statement is not part of your account, then the AO requires the approval of change. Okay. Now we come to next provision, section 142A. 142(2)A. It's a special audit. It's a income opportunity for chartered accountants. Okay. What is the section says? In brief, we'll go in detail. If tax officer finds the accounts of the assessee is complex, okay, then who is the master in accounts? Is we the chartered accountant? You the chartered accountant? So he'll ask you, he will request you, please audit the accounts of the assessee and give me a report on this point, whatever he wants to ask. And of course, it's not free of cost, it's not a favor to the government. The government will pay you, not the assessee, the government will pay you. And the remuneration is quite good. So what the rate is prescribed is somewhere around 3,750 to 7,500 per hour. And this is a rate for you and your staff as well. Depending upon the qualification, they will nominate, they will provide the rate and give you the fees. Okay. But who will decide who CA will do the audit? Will it be you or your friend? So it's the commissioner. Commissioner or chief commissioner, they decide, they have a panel of chartered accountants and they nominate chartered accountants to do the special audit. Okay. You understood? Who asks for the special audit? It's the tax officer. When will he ask? Of course, he will ask only during the course of proceedings. So AO may at any stage of proceeding. When he's doing assessment, he finds difficulty in understanding the accounts of the assessee because it's complex. He requires the help of the expert. And who is the expert in the accounts? It's always a chartered accountant. So when during the course of proceeding, he finds difficulty, he will require the previous approval of principal commissioner, commissioner, chief commissioner, or principal chief commissioner. And after giving the assessee an opportunity of being heard, he shall direct the assessee to get the account audited by a chartered accountant. Who's chartered accountant? Assessee will not choose a chartered accountant. The chartered accountant shall be nominated by these big senior officer. What we call them, CCIT, CCIT, CIT, and CIT, is a senior officer, big senior officer. You may also require to get the inventory valued. But such valuation shall be done by the post accountant, again nominated by big senior officer. At this point, I hope you understand the hierarchy of the tax officer. I'll discuss with you in brief. So, the tax officer generally starts with the IP, income tax officer. Then he is promoted to ACIT, then BCIT, then JCIT, then additional, then commissioner CIT, then principal commissioner, then chief commissioner, then principal chief commissioner. So this is the hierarchy in the income tax department. When a person gets IRS, he qualifies IRS, he is appointed as ACI. Okay. Then this is his career path. In my income tax, the assessment generally done by ACIT, BCIT, and IP. These three people generally do the assessment. So when I say AO, I am generally referring to these three people. So if AO is doing an assessment and during the course of assessment he finds some difficulty in the account, he will go to his seniors, chief commissioner or commissioner, and ask for their approval. And then he will give an opportunity to the assessee. See, there is a principle of natural justice. What does it say? It says that no person can be punished unheard. If you are doing something against a person, you have to give him an opportunity to put his story, his line of story before you, and then you decide whether he has to be punished or not. So, if you're asking an SSC to get his account audited, you first give him an opportunity of being heard that I don't understand your account, and I request, I am going for a special audit. Let the SSC try to explain you the accounts of his, so that it may be it is possibility that you understood the accounts and you don't require the special audit. So you first have to give an opportunity to the SSC to try to convince you that accounts are not complex. But still, if you find it complex, if you find the need of special audit, then you can get the U means the tax officer AO may take the previous approval of the senior officers, most senior officer, and direct the SSC to get the account audited or get the inventory valuable. What are the circumstances in which the tax officer can get the accounts audited or inventory value? If he finds the nature and complexity of the accounts, if the accounts are complex, okay, if the accounts are voluminous, volume of the data, or doubt about correctness of the account, if there doubt about correctness of the account, if there multiplicity of transactions in the account, or specialized nature of business activity. Earlier, only one thing was there. If accounts are complex. In 2013, I guess, the scope was enlarged to include these 4 points. What are 5 points? Depending upon the nature and complexity of the accounts, volume of the account, doubt about correctness, multiplicity of the transaction, and lastly, the specialized nature of the business. If he finds any of these things, then tax officer may request the senior officer to give them approval, and with the approval, he will direct the SSC to get the account audited or get the inventory value. So 3 things. One, the direction for special audit has to be given during the course of assessment. It cannot be given before the start of the assessment or after the completion of assessment. When the assessment is undergoing, during that period, the tax officer can give a direction to us to get the account audit. Once the assessment has been completed, this section has no role. Secondly, direction can be given only with the previous approval. First, a tax officer has to take the approval, assessing officer has to take the approval of senior most officers. Then, before issuing direction, it's mandatory that assessee has been given a opportunity of being heard. Okay. Tax officer shall decide the amount, the period during which the report has to be furnished. Okay. But he may, on his own or on the request of the assessee, extend this period, but the aggregated period cannot exceed 180 days from the date of receipt of direction. So he can on his own. Why will AO on his own exceed the period of submission of report of special audit? See, earlier it was only the assessee who could have requested the AO to extend the period. But there may be a situation that the chartered accountant or the cost accountant may require more time. There was no option for the CA or the cost accountant to request for the extension of time. So what the law amended, and it said that now the AO suo to also extend the time. So why will AO suo to extend? When there is a request from the CA or the cost accountant to the AO that they require more time, then he will suo to extend the time. But the maximum time which is available to get the special audit done is 180 days from the date of receipt of direction. Okay. You have to keep in mind this time limits. There are a lot of time limits in this chapter. You have to keep in mind. Okay. The expenses of the audit is not borne by the assessee. It's borne by the central government. Expenses of such audit valuation, including remuneration of CA or cost accountant, shall be determined by the senior most officers, and expenses are determined shall be paid by the government. See, there is a basic concept. Whoever pays you the remuneration, you are loyal to them. So, once the remuneration is paid by the assessee, there was an apprehension that CA may not do the justice for which the work is awarded, and therefore the law changes and says that Examination shall be paid by the expense shall borne by the central government. Okay. Now there is complete independence. There is a case in the Supreme Court. See, what happened is that if the assessee doesn't cooperate in the special audit, he does not submit the special audit report, then tax officer can do the best judgment assessment. We'll study in a minute about what is best judgment assessment. It's an assessment on the basis of tax officer, not much dependent upon the assessee. It's something like a penalty. So what happened is that assessee shows that I cooperated entirely with the chartered accountant, but he, for whatever reason, not too logical, for a frivolous reason, he did not done the audit. So why should I be punished? Supreme Court said perfectly, if he has not done his duty, then the assessee shall not be punished. Assessee shall not be liable for consequences of failure to get the account audited if nominated CA refused to audit the accounts of the assessee. In such case, the department shall nominate another CA. Okay, understood? Any doubt? Assuming one thing, if the tax officer gives a direction of special audit without giving the assessee an opportunity of being up, then what the option the assessee has? So in such cases, an appeal can be filed only against an order. This is not an order, this is a direction. So whenever there is no remedy under the law, there is a constitutional remedy of writ or SLP. Writ is filed before the High Court, and after that, SLP is filed before the Supreme Court. So if the assessee feels that direction issued are not in accordance with the law, without giving an opportunity of being up, or if the assessee feels that my accounts are neither complex and doesn't fall in any of these clauses, still the AO has issued a direction to get the accounts audited. He can challenge the direction before the High Court in a writ proceeding. If there is no appeal under the Income Tax Act, he can challenge the direction before the High Court, and High Court may decide depending upon the situation of the case. High Court may quash the direction, may uphold the direction, as the case may be. Okay. There is no requirement that once the accounts have been audited, they cannot again be special audited. So even if the accounts have been audited under the Companies Act or under the Income Tax Act, Section 44AB, still AO can ask for a special audit. Okay. Courts have said in multiple of cases that this provision should not be used in a very casual manner. So AO must try genuinely, honestly to understand the accounts of the assessee, and if there is genuine required for the audit, only then this section should be used, because it's an effort for the assessee. It's a more work for the assessee. It has the consequences of the assessee. Okay. Lastly, law says that whatever report the AO gives, and if the report is against the assessee and tax officer wants to use that report in the assessment proceeding, then again he has to give the opportunity of being heard to the assessee. See, there is a principle of natural justice which will apply in all cases. This principle of natural justice is generally applicable in case of assessment and appeal. So whenever you will study the assessment and appeal, this provision will come that whenever there is any act which is against the assessee, then assessee must be given an opportunity of being heard. If such opportunity is not given, then the courts may quash that act. Okay. Any doubt? Do ask if there is any doubt. Huh? Next is we have not yet started the assessment. Okay, we are just doing the background work. We studied the notice under section 142(1), where the notice can be issued to call for the ROI or any other information or document. Okay. Then we studied the special audit or inventory valuation under section 142(2)(a). Okay. Now, third point is reference to valuation officer, section 142. If during the course of assessment, assessing officer requires the valuation of any property, asset, or investment, he can refer the valuation of such asset, property, or investment to a valuation officer. See, my assessing officer is not expert in everything. So they are valuation officer hired by the income tax department who are expert in valuation. So whenever there is any need arises to value something, the tax officer may refer the valuation to such officers. Okay. Generally, it arises when tax officer is required to compute the fair market value of something. If you remember, if you receive the assessee receives some gift of immovable property or movable property, not in cash, then such gift is taxable in the hand of assessee under section 56. But in such case, you have to compute the FMV. Who will compute the FMV? AO is not expert in computing the FMV. So AO refers the valuation to the valuation officer. So this section gives him the power to refer the valuation to a valuation officer. Reference to valuation officer. Section 142A. The AO may, for the purpose of assessment or reassessment, make a reference to valuation officer to estimate the value of any asset and submit a copy of report to him. The valuation officer shall estimate the value of asset after considering such evidence as the assessee may produce, or he may gather and after giving the assessee an opportunity of being heard. So, what will the valuation officer do? He'll visit the place, he'll collect the evidence, he'll ask the assessee to submit whatever assessee wants to submit, and then he prepare a report and submit it to the assessing officer. He has to prepare a report within a period of 6 months from the end of the month in which reference is made. Okay. And if the report is against the assessee and tax officer is wants to use such report in the assessment proceeding, then again similar thing, principle of natural justice. He has to give the opportunity of being heard to the assessee before he uses such report. My friends, we have studied a similar provision in the chapter capital gain. There was a section 55A which also gives a power to the tax officer to refer valuation of any capital asset to the valuation officer. In the section 55A, an AO can refer the valuation of a capital asset to a valuation officer. Similarly, under section 142A, AO can refer a valuation of an asset to a valuation officer. So what's the difference? I tell you. Section 55A is specific to the capital gain head. Here you can get the valuation of a capital asset from the valuation officer. 142 is really a general section. Okay. The most important difference is that if the reference is made in section 142A, then there are provisions which says that the time limit for completion of assessment shall be extended by the time the AO receives the report from the valuation officer. So whatever the time of completing assessment proceeding, it gets extended if the reference is made under section 142A. However, if a reference is made in section 55A, there is no such extension. The time limit assessment has to be completed within a prescribed time limit. So within that time limit only, the AO has to get the report from the valuation officer and complete the assessment. If AO does not get the report within such time limit from the valuation officer, then he has to complete the assessment without such report. When the reference is made in section 55. But if the reference is made in section 142A, then the law allows the extension of time limit for the assessment proceeding. Okay. So let's have a break for 5 minutes and then we can continue with the actual assessment. Okay. Thank you. Let's break. You had a break? Let's start. So we have discussed till now. Yes. Anything, sir? Okay, let's start. So we have discussed till now section 142.1 inquiry to call for the return of income or for to call for some information on document as the AO may require. 742.2a special audit or inventory valuation by a chartered accountant or a cost accountant nominated by the senior most officer. The expense is borne by the central government. The report is to be submitted by 180 days from the date of receipt of the direction. Before issuing direction, the tax officer AO has to obtain a previous approval from the senior most officers and has to give an opportunity of bringing her to the SSC. And SSC or the AO CO motor may extend the period for submission of report, but maximum period cannot exceed 180 days from the date of receipt of direction. Then lastly, we did is section number 142A valuation to the valuation officer. So AO may refer the valuation of any asset, property, or investment to the valuation officer, and the valuation officer shall submit the report within 6 months. Then we understood what's the difference between 142A and 55A. Okay. This quick revision helps in revising things. Hope you all guys are with me. In case you have any problem, any doubt, do let me know. Now we are moving towards some serious topics. I told you when I file return of income, my return gets processed. So return gets processed under section 143.1. It is purely computerized, no human intervention. It's done by the CPC. So Income Tax Department has a centralized processing cell in Bangalore. So every return filed is generally processed in section 143.1. Some people say this as a summary assessment, but it's not an assessment. It's just an processing of return. At the end of the processing, you don't get an order, you get an intimation. So what happens is that, what is 143 intimation, how it looks like? It looks like something similar to your computation. So it has where income component, income under salary, house property and all. There are two columns. One is the amount which is furnished in the return of income. As return of income furnished by the SLC. And second, as per department, the section 143, what should be the amount? So there's a comparison. And finally, if the tax liability is same in both, then there's everything good, matter cool. But if there is a higher tax liability, then the assessee has to pay the tax, whatever is determined under 143.1. But it's again not an assessment. It's just the arithmetic checking or arithmetic accuracy of the return furnished by the assessee. See, let's go in detail. You will understand more. A return furnished by assessee in section 139 or in response to notice in section 142.1. Understand? AO may ask the assessee to furnish return of income under section 142.1. Even such return is also processed. Such return shall be processed by the CPC to make the following adjustment. In the processing, the CPC is authorized, allowed to make only these type of adjustments. The CPC cannot go beyond this. So the extent of adjustment which can be made to the return of income under section 143.1 is very limited. And therefore, it's not an assessment. It's just a processing of return by the computer. No human intervention. What it can do? It can check the arithmetical error in the return. If there is any arithmetical error in the addition, subtraction, it's generally not theoretical because the return is furnished digitally and the form itself computes do the all calculation. You need not to add anything. Everything is automatic. If there is an incorrect claim which is apparent from information in the return, so the claim which is incorrect has to be apparent from the information in the return itself. The CPC cannot rely on any external evidence. There is a claim on basis of a return in the return. of an item which is inconsistent with another entry in such return. So there are two inconsistent entries in the return. Okay. Assuming you have furnished, the assessor furnished his return of income and he has stated his age to be less than 60 years. But he is claiming a deduction of 80 TTB, the interest of 50,000, which is available only in case of senior citizen. So there's inconsistency. Even this inconsistency is not practically possible now because the tax return form takes care of this. Right? It used to be happen earlier. Or in respect of which information required to be furnished under that has not been so furnished. What would be the example of this? Say, if you claim, the SSC claims HRA benefit, house rent allowance, from the income and net salary, then there's a requirement that you may have to furnish the PAN of the landlord. And you have not furnished the PAN of the landlord, then CPC may disallow the HRA benefit. In respect of a deduction where such deduction exceeds the specified statutory limit. So under the Act, there are limits prescribed for all types of deduction. Say, if you're claiming a deduction of interest under that house property, then there's a limit of 30%. And if the SSC claims more than 30%, then the CPC shall disallow. Similarly, for deduction under Chapter 6A, Section 80C and all, there is a statutory monetary limit. If you're claiming a higher amount, then CPC shall disallow. Again, to a larger extent, it's theoretical because my computerized form takes care of everything. What are the other options in which the CPC may change my income? If there is any inconsistency in the return with respect to information in the return of any preceding previous year as may prescribe. So, I am setting off my loss of earlier year against the income of this year. But the return of income of earlier year was not filed within the time. So, I am not allowed to carry forward such loss, and therefore such a loss cannot be set off in this year. So, if this I have done, then the CPC shall disallow the set off of loss, because the loss for such year, the return for such year in which the loss occurred was not furnished within the due date. Disallowance of loss claim if the return of the year in which such loss was incurred was furnished after due date. Similar thing. Disallowance of expenditure indicated in the audit report. My tax auditor has mentioned in the audit report that there are some expenses which should not be allowed, and I have not disallowed them in the return of income, then such amount shall be disallowed in the intimation in the processing of return. Disallowance of deduction under Section 10AA or Part C of Chapter 6 if the return is furnished after due date. So these deductions, as we discussed in the earlier part of this chapter, are allowed only if the return is furnished within the due date. So if I am furnishing the return after due date and claiming this deduction, then this deduction shall be disallowed at the time of processing of return. Understood? So the extent of adjustment which can be done under Section 143(1) is only this much. There is no other thing which the CPC can do to my return of income under Section 143(1). But on account of this adjustment, if there is any tax payable, any amount payable, then the CPC will issue me an intimation. It's not necessary that CPC will issue intimation only if the amount is payable. CPC generally issues intimation all the cases, but if there is an amount payable or any loss which I have claimed in the return is adjusted, then CPC is mandatory required to issue me an intimation. An intimation shall be sent to the assessee specifying the sum payable or refund due to him. Even if there is a refund, then intimation shall be issued. No adjustment shall be made unless an intimation given to the assessee. But if there has to be an adjustment, then for that adjustment, intimation has to be given. If you're making any adjustment like this under these clauses against the assessee, then assessee must be given an opportunity of being done. Similar principle of natural justice. The response received from the assessee shall be considered before making any adjustment, and when no response is received within 30 days of issue of such intimation, the adjustment shall be made. So, say, I set off the loss of earlier year against the income of current year. Okay. But an intimation sent to me that the return for such year was furnished late and therefore this adjustment, this set off is not allowed. Okay. But I may have obtain a condonation from the CBDT or commissioner, and in such reply, I will furnish the condonation that there is a condonation which allow me to furnish a return late, and basis this condonation, the loss should be allowed. And once I furnish this, the CPC shall allow the loss. Of course, because I have a condonation order which allow me to furnish the return, which condone the delay in furnishing the return. So that's why the opportunity should be given to the assessee. Intimation also sent if law declares the return adjusted but no sum is payable. There is a time limit of issuing an intimation. No intimation shall be sent after the expiry of 9 months from the end of the financial year in which return is made. What's the time limit? Once the return is made, you will end the financial year and 9 months from such date. So if return is filed on 31st July 26, as generally in our case, then the intimation can be issued up to 31st December 27. You will end this year, which is 31st March 27, and 9 months from 31st March, which comes to 31st December 27. Understood? So this is the date by which the intimation can be issued. See, there are two words. One is issued and one is served. Issue means when the department issue, and serve means when the letter, the intimation, the order is received by the assessee, received by the recipient. When the issuer issue is the date of issue, and when the recipient receive is the date of serve. There may be a gap between issue and serve. Okay, so I have to see the 9 months for the issue. The intimation must be issued by 31st December 27 in this case. So in this case, say I file a return of income on 31st December 26. If the intimation is issued on 31st December 27 and is received by me on 2nd January 28, it's a valid intimation because 9 months for the period of issue. If it's issued on 2nd January 28 and received by me on 3rd January 28, then it's an invalid intimation. Understood? So period to issue an intimation is 9 months from the end of the financial year in which return is furnished. Okay, but this period is only for issue of intimation. Even if intimation is not issued by within this period, still there is no bar. You can have the refund. Right? The limitation is to issue intimation and not to issue a refund. See, I told you these adjustments are the exhaustive one. They are CPC cannot go beyond that. See an example. The chartered accountant follows a cash system of accounting. They generally follows cash system of accounting, chartered accountant lawyer. What happened is that he received a fees of rupees 50 lakh during the year, but the client deducted TDS on 70 lakh. On accrual basis, but I received 50 lakh, so I will offer the income only 50 lakh. But my 26 AS form shows the receipt of 70 lakh, the amount paid or payable 70 lakh. So can CPC increase the income? Answer is no, because this type of adjustment is not covered in any of these clauses. You are with me? Okay. Assuming tax audit, I furnish return of income, say rupees 15 lakhs. What the tax auditor said in the tax audit report, he said that there are expenses of amounting to rupees 2 lakhs which relate to the prior period. Okay. So I did not disallow this 2 lakh rupees in my return of income. What will happen? At the time of processing of return, that CPC shall issue a notice to me, intimation to me, that this 2 lakh, why it should not be disallowed, basis the tax audit report. I'll submit that this 2 lakh, though related to prior period, but they were crystallized during the year. So we know under that PGBP, if the expense is crystallized during the year, it is allowed during the year. But CPC practically will not accept my reasoning, my argument, and this 2 lakh shall be added in the processing. This happens. So in the processing of return, they will issue an intimation with the income of 17 lakh. But this intimation is appealable. I told you that appeal can be filed only against an order. This intimation is not an order, but law specifically allows assessee to file an appeal against an intimation before the CIT. So I file an appeal to the CIT appeal against the intimation, and there I will submit that this 2 lakhs was crystallized during the year. I submit the proof in support of my argument, and CIT appeal, if he finds the proof relevant, he will allow me the benefit and delete the addition. Understood? So what I want to tell you is that this intimation is not an order. This is not an order, but still it is appealable because the law specifically allows me that assessee can file an appeal against the intimation. Okay. Also, this intimation can be rectified as well by both. Even the assessee or the tax officer may rectify the intimation. Rectification for the mistake apparent from record. And there was a third thing I told you, revision. Revision is again for an order. And this is not an order and no specific provisions there allowing assessee to go for the revision. So intimation cannot be revised. It cannot be revised. Revision is not possible. Yeah, intimation. So intimation, assessee can file an appeal against intimation. An intimation can be rectified either by the assessee or by the department, but revision is not possible for an intimation under Section 143(1). Okay. Once an intimation is issued, can assessee revise the return? See, the time limit for revision of return was either 3 months prior to the assessment year or before completion of assessment. So, assuming there is time, by 31st December, I filed a return of income, say on 31st July 26, and the return is processed. I receive an intimation on 31st August 26. Now I want to revise the return. Can I do? Because I still have a time if I see the 31st December time limit. But can somebody say that assessment has been completed and therefore you cannot revise the return because there is 31st December or before completion of assessment, whichever is earlier. But I told you this is not an assessment. This is just an intimation. So this just a processing of return is not considered an assessment. Though some people say summary assessment, but this is not the assessment which the Act treated as an assessment. It's still an intimation. So I can revise my return even after the intimation. I can file a revised return. I can file a belated return, not possible. I can file a revised return. Belated return is not possible because once there is an intimation, I must have filed a return. No? Therefore, such return has to be processed. So belated return is not a question. I can file a revised return. I can file an updated return as well. It's not an assessment. Okay. Let's move. Any doubt till here? Do let me know. Lastly, if no intimation is received, then acknowledgement of return is treated as an intimation. Okay. That once you file a return, you get an acknowledgement from the department, the return is filed. Such acknowledgement is treated as an intimation. If you don't receive an intimation, there is no tax payable, no loss adjusted. Okay, guys. Now, focus. All with me. We are starting the assessment. We are starting the basic assessment. It's called scrutiny assessment. So, what happens is that around 1 to 2% of the return, only 1 to 2% of the return are picked up for the scrutiny assessment. Okay. So, for scrutiny assessment, the mandatory that assessee issues a notice under Section 143(2). So, if scrutiny assessment made under Section 143(3), and for this, a notice is issued under Section 143(2). But notice under Section 143(2) can be issued only if return has been furnished. If assessee has not furnished the return of income, then 143(2) cannot be issued. It may be possible that you may issue a notice under Section 142(1), asking assessee to furnish return of income. Once assessee furnish a return of income, then AO may issue a scrutiny notice under section 143(2). But before issuing a notice under section 143(2), there has to be a return of income. Okay. So where return has been furnished, the AO may serve on the assessee a notice requiring him to produce any evidence on which he may rely in support of the return. Notice shall be served up to 3 months from the end of the financial year in which return is furnished. So time limit to issue a notice is not to issue a notice, it to service of a notice is 3 months from the end of the financial year in which return is furnished. So 3 months is the date of service, not date of issue. So by end of 3 months, the notice must have been served to the assessee. So if I file my return on 31st December 26, then the notice must be served on me by 30th June 27. I'll end this year 31st March 27 and 3 months from the end of the financial year. 3 months from the end of the financial year, return is furnished. So I furnish my return 26-27 and this year, then 3 months, April, May, June. So by 30th June, the notice must have been served on me. If it is issued on 30th June and served on me on 1st July, then it is invalid notice. It's not valid notice. An assessment cannot be made on the basis of invalid notice. If assessment made on the basis of invalid notice, then it is void unless I cooperate. We'll discuss this in the next class. So, what is the time limit of issuing a notice is 3 months. So, two things important. One thing is scrutiny assessment can be made. A scrutiny notice can be issued only if the assessee has furnished a return of income, no exception. Secondly, the time limit for the notice is the notice must be served. Here the time limit is served within 3 months from the end of the financial year in which the return is furnished. Assuming I file a revised return. Updated return. For AY 26-27, I file a updated return on 31st December 29. I can file. Then in such case, scrutiny notice for AY 26-27 can be issued up to 30th June 2030. You are with me? Because time limit not from the assessment year, is from the year in which return is furnished. If return is furnished in financial year 29-30, then I will add the date 31st March 30 and I will add 3 months, which comes to 30th June 2030. You with me? Okay. Do let me know if there is any doubt. Now we are coming to the assessment part, scrutiny assessment. So once notice is issued, then AO has to do the assessment. So AO shall by an order in writing assess the total income or loss of the assessee on the basis of evidence produced by assessee and material gathered by AO, and determine the sum payable by assessee or refund due to him on the basis of assessment. So what happens is that, friends, once a notice is issued under section 143(2), the assessee submits his document, its replies, its clarification. Then again a subsequent notice is issued. And subsequent notice generally is issued under section 142(1). So only once the 143(2) is issued to initiate the assessment, then all information are called for generally under section 142(1). Then by AO issue the 142(1), assessee submits reply, AO issue 142(1), assessee submits reply. It goes on. And finally, the AO passes an order. He may accept the returned income or he may make an addition. So depending upon whatever he does, he may determine the sum payable by the assessee or he may even determine the refund due to the assessee. So in case of 143(3), it's not necessary that it's only against the assessee. It may be in favor of assessee. So he may issue a refund, he may determine a refund due to the assessee under section 143(3). So there may be a situation where there is some deduction which the assessee may not have claimed in the return of income. AO is entitled to allow such deduction in the assessment proceeding. Okay. At this juncture, there is one important thing. There is a case law by the name Goetz Limited. Goetz India Limited. Supreme Court. What happened in this case law is that assessee furnished a return of income and he forgot to claim some deduction. The limit for filing revised return also expired. But his return was picked for scrutiny assessment and he furnished a letter to the AO requesting him to give the deduction. AO denied it. Matter reached through the Supreme Court, and Supreme Court said that assessee can claim a deduction only through return of income, either original or revised. Assessee cannot claim a deduction through a letter to the AO, and therefore the action of AO was held to be justified. Okay, but it doesn't mean that suo moto cannot give a deduction. If AO finds that there is some deduction which the assessee is entitled to and he forgets to claim, then he can suo moto give a deduction. So there is a CBDT circular which says that tax officer is not only for the collection of revenue, he is there to help the genuine assessee. If assessee has genuinely omitted to claim a deduction which he was legally entitled to and AO come across, then he can suo moto allow the assessee to such deduction, and in such case, under assessment 143.3, the refund shall be allowed to the assessee. So, under section 143.3 assessment, even a refund can be allowed to the assessee. Okay. Okay. So, we are very much clear that if 143.3 assessment made without a notice or with a time bar notice, then such assessment is a void assessment. Okay. Now, if you remember, at the time of filing return of income, doing return of income, we discussed about three types of entities. One was charitable. Then we discussed about section 35 entities who are referred to in the section 35 research, and we discussed about entities who are entitled to exemption under section 10. So what law did was law made it mandatory for these type of entities to file return of income. So what happens is that if during the course of assessment, EO finds that these entities are not doing the activities for which they were given the approval registration. I told you they are given the approval registration subject to some conditions, and if AO finds that they are not fulfilling this such condition, then what the AO does is he will not withdraw the assumption because he cannot. If the assumption is given by a superior officer, how can a lower officer withdraw such assumption? Okay. What he will do is, in case of charitable organization, the assumption is given by the CIT or PCIT. He will write a letter to the CIT or PCIT saying that, in my view, the assumption should be withdrawn because of this reason. The trust of the institution is not working as per the object or as per the condition on which the registration approval was given. And if CIT, PCIT withdraw the assumption, then AO shall complete the assessment on the basis without allowing the assumption, on the basis of order of CIT, PCIT. Or if CIT, PCIT doesn't allow the assumption, doesn't withdraw the assumption, then AO will pass order after allowing the assumption. Okay. And the time which is spent in writing a letter to the CIT and receiving an order from them is excluded. Okay. Similar thing is section 10 entities. Even these entities are given approval by the central government or a senior officer. So what will AO will do? AO will write a letter to the authority who has given the registration, who given the approval to these entities, and ask them that, in his view, the registration approval should be withdrawn. And once the order is received, if they're withdrawing the registration, he will pass the assessment order without the assumption. Similarly, for section 35 entities, he may ask the registering or approving authority that the entity is not working in accordance with the condition, and therefore the approval registration should be withdrawn. Okay. And in all these cases, the time spent in writing a letter to the authority and receiving their order is excluded from the time limit. Okay. So, while making assessment on the person referred to in section 139(4)(c), section 10 entities, AO shall not disallow the assumption unless AO has intimated central government or prescribed authority. Who are they? They are the person who have given the registration approval. AO has intimated the central government or prescribed authority the contravention of the provision of section 10 by such person, and the approval granted to such person has been withdrawn by the central government. So unless the approving authority withdraw the approval, the AO cannot withdraw the exemption. Okay. AO shall recommend the central government to withdraw the approval granted to the institution referred to in section 35 after giving the opportunity to bring her to such institution if he considers the activity of such institution are not being carried on in accordance with the conditions subject to which approval was given. Okay, now with me, simple points. Any trust or institution referred to in section 1023C, clause 4, 5, 6, or 6A. Because under this clause only, the approval is required, registration is required. Or section 11 has committed any specific violation. Specific violation means a violation which result in withdrawal of the approval. The AO shall send a reference to PCIT or CIT. These are the person who register a trust to withdraw the approval. And AO shall pass an order after giving effect to the order passed by PCIT or CIT, either cancelling the approval or refusing to cancel the approval as the case may be. So if they cancel the approval, the AO shall pass the assessment order without allowing the exemption to this entity. But if they refuse to cancel the approval, AO shall pass an order after providing the exemption to these entities. What are the special violations which result in withdrawal of the registration? This we have studied in the charitable chapter. We are just revising it, again taking it. If the trust apply its income other than for the object of the trust or for private religious purposes, or where the trust is charitable, it applies the income for a particular religious community. Then in such case, its registration is liable to be withdrawn. Or if trust runs a business which is not incidental to its object, or even if the business is incidental, trust does not maintain a separate books of account of such business. Or if AO finds the activity of trust are not genuine, or is not being carried out in accordance with the or subject to the condition for which it was registered, or there was condition of some other law which the trust was required to be complied with, and that trust has not complied with the such other law, and an order under such other law has been passed against the trust, and such order has attained the finality, then also the registration under Income Tax Act of such trust can be withdrawn. With the registration application filed by the trust has to apply for registration after every 5 or 10 years the case may be, and such registration application is incomplete or contains false or inaccurate information. In all such cases, if AO notice such violation during the course of assessment, he will write to the PCIT and CIT, and then PCIT CIT will decide as per that. Okay. So this was the assessment, scrutiny assessment, the most common assessment which happens. You will deal a lot of this type of assessment in your practice, after you qualify as a CA. Yes, I treat you as CA. For me, you are qualified, but for issued, you have to get a degree. Then comes the BJ, Best Judgment Assessment 144. See, what happens is, I told you 143.3 can be done only if the assessee has furnished return of income. But there may be a situation that assessee doesn't furnish a return of income. Even if the AO issue a notice under section 142.1, assessee still doesn't furnish a return of income. Then what recourse the department have? Department have a recourse of section 144. Yes, Ms. Gita. Yes. The registration for trust is valid for 5 years. So after every 5 years, the trust has to apply for re-registration. This we study in the charitable chapter. Okay. So if assessee doesn't furnish a return of income, or he doesn't cooperate during the course of scrutiny assessment, say he furnished a return of income, his case was picked for scrutiny assessment, notice was issued under section 143 to submit the proof or document in support of a return, he doesn't reply to that. Then again a notice has been issued, doesn't reply to that. He's not cooperating in the assessment proceeding. Then what the department does is, it does an assessment under section 144. We called it ex parte. Ex parte means without the assessee. So when can AO does the assessment under section 144? If a person failed to furnish a return under section 139, 1, 4, 5, or 8A, even he doesn't furnish the updated return, or to comply with notice under section 142.1 or 143.2. So in notice was issued under section 142.1 to asking him to furnish return of income or to furnish some document or information. He doesn't comply with that. Or a scrutiny notice was issued, he doesn't comply with that. Or he failed to comply with the direction issued for special audit or inventory valuation. Remember, we discussed at the time of 142.2A special audit that even if there is a fault of the CA, then assessee cannot be penalized. So one of the penalty is if it does not furnish a special audit report, then there can be a bad judgment assessment on the assessee. The Supreme Court said that if CA is not doing the audit, then this bad judgment assessment cannot be done on the assessee. What are the reason on which BJ can be done, bad judgment assessment? If assessee does not furnish a return, if he does not comply with the notice, or he does not comply with the direction. In all these cases, either of these three cases, the assessee can be subject to the bad judgment assessment. So what is bad judgment assessment? What happens in that? In this case, you estimate the income. He doesn't have any support from assessee. The assessee is not submitting document. What option he has? You only have an option to estimate them. So what the AO shall do? AO shall by order in writing assess the total income or loss of the assessee to the best of his judgment. So it's a judgment. Therefore, it's called best judgment assessment. It's not based on the facts. It's based on a judgment. On the basis of material gathered by him. But that judgment cannot be adopted. He has to be based on some material. Maybe if the assessee is into the textile business, what the AO will do? He will determine the profit rate of textile business, textile industry, and apply on the turnover of the assessee. The assessee is not giving the details. What else AO can do? So he will do the judgment on the basis of his best of his judgment. He will do the assessment on the basis of best of his judgment, but that has to be something logical. Right? It cannot be purely ad hoc. And the AO shall determine the sum payable by assessee on the basis of such assessment. And it will determine the amount which is payable by the assessee. See, there is the word or different due to him, as was there in 143.3. Some determined some payable by the assessee or different due to him is not there in 144. So in case of 144, AO shall not issue the refund. Okay? But AO shall give an opportunity of being heard to assessee to show cause as to why the assessment should not be completed to the best of his judgment. To complete assessment under this section, a specific show cause has to be issued, giving the assessee an opportunity to provide why an assessment under section 144 should not be made on him. So give him another opportunity. But such opportunity is not required if notice under section 142.1 has already been issued. If notice has already been issued, then there is no need to issue a separate show cause notice in section 144. Okay. So this was two types of assessment which we have covered. Okay? Today we have to complete three types of assessment. 143.3 scrutiny, 144 best judgment, then income escaping 147. Okay? Before that, there is a small section 144A. It's a direction given by Joint Commissioner. I told you the assessment done by the ITO, Assistant Commissioner, Deputy Commissioner. Joint Commissioner generally doesn't do an assessment. But Joint Commissioner has been given a power. They can guide the AO to how to do the assessment. And in which section they guide the AO? It is section 144A. A JC may suo moto. He may himself guide the AO, or on request of AO, or on request of assessee. Either himself or AO may request for the guidance, or assessee may approach the JC Joint Commissioner, and request the JC to guide the AO because AO may not be appreciating some facts of the assessee in right perspective. In either of these cases, whether himself or on the request of AO or assessee, JC may issue a direction to AO as he thinks fit, whatever direction he thinks fit. For the purpose of completing assessment, such direction shall be binding on AO. And since JC is a boss of the assessing officer, whatever direction he gives, it is binding on the AO. Okay. But no direction shall be issued which are prejudicial, which are against the assessee, unless the assessee has been given an opportunity to inquire. Principle of natural justice. You will find everywhere. Okay. But law says if only JC provides the guidelines on which the assessment should be completed, then this is not considered as a prejudicial to the interest of the assessee. Okay. So this was a small provision. Again, no appeal is possible against the direction. Even if the direction is issued against the assessee doesn't have a recourse to file an appeal because not an order. Yeah. So, but what will happen that this direction is binding on the AO and AO will do the assessment as per the direction, then that assessment order is appealable. So what assessee can do is he cannot appeal against this direction, but he can file an appeal against the assessment order which is made in accordance with this direction. Now we come to the last and the most important part of our assessment procedure, section 147, income escaping assessment. What happens is that this is the most powerful tool in the hands of the department. What department does is here, see, if you see under section 143.2, there was a time of only 3 months from the end of financial and return of funds for the department to start the assessment. But under 147, the department has a time of 5 years from the end of the financial year, from the end of the element assessment year, for which the income is supposed to be escape assessment. So what happens is that for 143.2 scrutiny assessment, department doesn't need a specific information to start that. He can start it without giving any reason. He can scrutinize on his own. He doesn't need a reason that there is likely to be some escapement of income. But section 147 can be initiated only if the tax officer, the assessing officer, has some information in his hand which suggests that there is an escapement of income. To be very, very focused on this, we will discuss it in detail. This is very important. Practically as well, from example point of view also. So, if the AO, assessing officer, has some information in his hand which suggests, the word is suggest. If AO has information which suggests that income has escaped assessment, then he may invoke the provision of section 147. But before invoking the provision of section 147, principle of natural justice has to be complied with. So, what the law says, there is section 148A. So, law says if the AO has some information which suggests that the assessee has escaped income, has escaped the tax, then he will provide that information to the assessee and ask him why an assessment under section 147 should not be initiated in his case against him. So an opportunity shall be given to assessee to explain that why this information doesn't result in an escapement of income. So what happens is that generally there is a cash deposit in the account of assessee of rupees 1 crore. And if furnish a return of income of rupees 10 lakh, then there is clear a big mismatch and this creates a doubt. It suggests that there is some income which has escaped assessment. So what will AO will do? AO will issue a notice to the assessee saying that I have an information, I have a bank statement which I received from your bank, which clearly proves that there was a deposit of 1 crore in your account during this financial year. And this is not corroborated, this is not in accordance with the return filed by you. Tell me why should not I initiate a income escaping assessment on? Then assessee will furnish a reply. Assessee may furnish a reply that this was a loan taken from a Mr. X, and this is Mr. X. His PAN number is this, his address is this, and his return of income is this. He has a credibility of giving me 1 crore rupees loan. He has such a network, and therefore it should not be treated as an income escape. It's a loan, it's not an income. So, if AO is satisfied, matter ends here. If AO is not satisfied, he takes the approval from a senior officer and issue a notice under section 148. So this was a 148A, where the AO issue a notice giving information why an assessment should not be initiated. But once he is satisfied that assessment should be initiated, he initiates an assessment by issuing a notice under section 148. So assessment is initiated by issuing a notice under section 148. Issue of notice under section 148A doesn't mean the initiation of assessment. So remember, updated return cannot be filed once the assessment is initiated. So assessment initiated by issue of notice under section 148. Okay. So if AO is not satisfied with the reply of the assessee, then he will initiate an assessment. He will issue an order under section 148A saying that I am not satisfied, and he will simultaneously issue a notice under section 148. What does notice under section 148 says? It says nothing. It just asks assessee to furnish return of income. Even if assessee has already furnished a return of income, he asks assessee to furnish again a return of income, which may be similar or which may be different depending upon the assessee, what assessee wants to disclose. Okay. So 148 gives a time, maximum time 3 months, to the assessee to furnish a return of income. We will all study this, and I'm discussing this with so that it goes into your mind. It will be help when we study this. So once assessee furnish a return of income, or he may not furnish a return of income as the case may be, then assessment happens under section 147. Similarly, assessee AO issues a notice. Assessment happens, though assessment is happening in section 147, but it happens under section 143 too. So what the law says is, what the order says, assessment order under section 147 is that with section 143 too. So once the assessee furnish a return of income under section 148, in accordance in pursuance to notice under section 148, then AO issue 143 2, and then 142 1. Assessee furnish reply, AO issues notice, assessee furnish reply, AO issue notice, and finally an order is passed under section 147. So understood? There are 3-level process for making an assessment under section 147. First, you have to issue, means the assessing officer has to issue a notice under section 148A. Then an order is passed under section 148A, whereby the assessing officer says that this is a fit case to issue a notice under section 148. There are notices issued under section 148 asking assessee to submit the return of income, and then assessment is done under section 147, and order is passed. Okay, so we'll go in detail. This was broadly the procedure of income escaping assessment. Where AO has information which suggests that income chargeable tax has escaped assessment, he shall provide such information to the assessee. So whatever information he has in his possession, he will give this information to the assessee and serve upon him a notice to show cause as to why a notice under section 148 should not be issued in his case. You understood? So assessing officer will give the information to the assessee. This information I have, and now tell me, basis this information, why should not I initiate an income escaping assessment on you by issuing a notice in section 148? So there is no time limit by which the assessee has to give the reply. The time limit shall be provided by the AO in the notice. On receipt of the notice, the assessee may furnish reply within such period as may be specified in the notice. Okay? The AO shall, on the basis of material available on the record, whatever material he has gathered, and taking into account the reply of the assessee, if any. If the assessee has furnished the reply against this show cause notice, both the material which he has and the reply which he received from the assessee, he shall take into account both of them and pass an order with the prior approval of specified authority, determining whether or not it's a fit case for issue of notice under section 148. So we'll take the approval of specified authority. This is authority which we study in a minute, and he'll pass under order under section 148A. So AO requires the approval of specified authority only at the time of passing an order under section 148A. For issuing a show cause notice to assessee, AO does not require any approval. Understood? Yes, Mr. Sanjay. A British return can be filed if notice under section 148 issued. Is that right? No. If notice under section 148 has been issued, then the assessment process has been initiated. In such case, a British return cannot be filed. Because under British return, assessment proceeding should not even be initiated. So once a notice has been issued, then under section 148, then it deemed that assessment proceeding has been initiated. This is the notice actually which initiate the assessment proceeding. For 143.3, 143.2 is the notice which initiate the assessment proceedings. Okay. The provision of this section shall not apply where AO has received information under scheme notified under section 135A. What does this say? It says that AO is not required to give an opportunity to assessee before starting the assessment, before issuing notice under section 48, if the information which the AO has been received under the scheme notified under section 135A. So this is what is the scheme under section 135A? You must have studied in the case of income tax authority, where there is a power of AO to ask for the information under section 133. And the scheme, the section 135A says that all such information can be collected through faceless manner. So if the AO has collected such information under section 135A, then he is not required to do the 148A procedure. He can directly issue 148 notice. He is not required to give the opportunity to assessee to show cause why an assessment should not be made on him. Okay. Now say what is all type of information which suggests that income chargeable to tax has escape assessment. Escape assessment means the tax has not been paid on such income, means the assessee has understated his income, has concealed his income. But the word is suggest. It's only a suggest. It's not conclusive. The AO cannot be conclusive at this stage. It only has an information, and this information suggests that, creates a doubt that the AO assessee has concealed the income. Okay. Any information in the case of assessee in accordance with risk management strategy formulated by board. So CBDT has formed the RMU, risk management strategy. What does this do? This is the artificial intelligence with the income tax department. They link the various information they receive from different sources about an assessee, and they compare this with the return of income furnished by the assessee. So they receive information about the sale of property, they receive information about the transaction in securities, shares, debenture. They receive information about the interest earned by the assessee. They receive information from different sources. Okay. So whatever, and then they compare. Who are comparing? It's only the computer. The IT system is comparing all this, and then they extract the cases. They bring out the cases, bring out the assessee where they feel. They mean the computer feel is that there may be a case of escapement of income. The information which the department has is in accordance with that information. The income should be more than what the assessee had disclosed in the return of income, or there is information in accordance with, in respect of which the assessee should have filed return of income, but the assessee has not furnished return of income. So there is a deposit of rupees 1 crore in your bank account. Department has the information, but you have not furnished a return of income. Then this creates a doubt. You have sold a property of rupees 5 crores, during the financial year, but in the capital gain head schedule, there is nothing is mentioned in the return of furnished by you. So this creates a doubt that you have concealed. So all this, the department has a big IT system. Through this, they bring out, they extract the cases where there is it suggests that the assessee has concealed the income. Or there may be an audio objection to the effect the assessment has not been made in accordance with the provision of the Act. So what happens is that whatever the department does, the assessment it does under section 143, 144, the department is also subject to the audit. The tax officer is also subject to the audit from the Controller and Auditor General of India, and also there's internal audit team. And if the team, the CAG team or the internal audit team has identified some mistakes in the assessment order passed by the AO, then such audit report of the team constitutes an information on the basis of which the assessment can be made. Okay, this information can be of any time. Say the addition was made under section 68, but if the tax is applied normally, Under 68, we all know that a special rate of 60% of tax is applied. But by mistake, the AO tax it as a normal income. That's a mistake which is highlighted in the audit. And this mistake can become a reason to initiate an assessment under Section 147. Any information received under an agreement referred to in Section 1998, we know double taxation avoidance agreement. If any information received by the AO under this from foreign country, then such information form the basis of doing an assessment. And information made available to AO under scheme notified under Section 135A, we just discussed. In this case, even 148A procedure is not required. And information which requires action consequence of an order of tribunal or court. So there is any order of tribunal or a court. In consequence to such order, there is a requirement to do the assessment which shows that the assessee has concealed an income. Any information emanating from the survey. If there is a survey, and from the survey there is information that the assessee has concealed income, then this information is a valid source on the basis of which you can do the income escaping assessment. Hope I'm clear. So this was the procedure. So all this information can become a source on the basis of which AO shall issue a notice to the assessee asking him why a notice under Section 148 should not be issued. The only exception is if the information is gathered is received under Section 135. In such case, there is no requirement to issue a notice. And if AO is satisfied, then he will issue an order under Section 148A asking assessee to furnish return of income under Section 148. Now we come to Section 148. So AO shall issue a notice along with copy of order passed under Section 148A. So AO requires an approval of specified authority for issuing an order under Section 148A. While passing an order, he will require an approval from the specified authority. On the issue of a notice requiring him to furnish within such period, as specified in the notice, a return of his income or income of any other person in respect to which he is assessable. So I told you 148 is nothing but it just asks the assessee to furnish a return of income. Within how much time? No time limit is given. The AO may give the time. But the maximum time is the period allowed to furnish return of income cannot exceed 3 months from the end of the month in which such notice is issued. The maximum time which is allowed to furnish return of income is 3 months from the end of the month in which notice is issued. So if notice is issued on 31st March, then the return has to be furnished by 30th June. Such return is considered as a return under Section 139. However, when return furnished beyond the period allowed, such return will not be deemed to be returned under Section 139, and accordingly, AO may proceed with best judgment assessment in such case. So even if after issuing a notice under Section 148, the assessee does not furnish a return of income, or he furnishes a return of income after the time limit allowed, then the AO may, depending on the circumstances, go for 144, the best judgment assessment. When will he go? When even after this 148 notice, the assessee doesn't cooperate and doesn't furnish the documents which the AO asks, then AO will not have an option. He will pass an order under Section 147, that way Section 147. Understood? So either the order is passed that with 143.2, 143.3, or that with 144 as the case may be. Yes. Where AO has received information under Section 1, under scheme notified under Section 135A, notice under Section 148 shall be issued after obtaining prior approval of specified authority. You remember in this case where the information is received under Section 135A, the AO is not required to do the 148A procedure. So if AO has not done 148A procedure, then in such case the approval of specified authority has not been obtained, because approval is required when the 148A order is passed. In this case, there is no order 148A because 148 procedure is not done by the AO, is not required. But then, while issuing order notice under Section 148, the AO has to take the approval. Because in all cases, AO has to take the approval, either under Section 148A or under Section 148. Okay. Now, there is Section 149, which gives a time limit for issue of notice under Section 148A or 148. Okay. So, what's the time limit? I'll tell you. the time limit is, maximum time limit is 5 years, but generally the notice is issued up to 3 years. The time limit can be extended from 3 years to 5 years only in case where the income escape or likely to be escape is 50 lakh or more. So if the income escape or likely to be escape is 50 lakh or more, then AO has a time up to 5 years from the end of relevant assessment year. If income escape or likely to be escape is less than 50 lakh, then he has to issue a notice within 3 years. So where income chargeable tax which has escape assessment as per information of AO amount to likely to amount to. Of course, it's only a suspicion. I mean, it's only a doubt that income is likely to escape assessment is 50 lakh or more. Then the notice in section 148A can be issued up to 5 years from the end of relevant assessment year. So in our case, if the assessment year is 26-27 and if AO feels the income escapement is more than 50 lakh, then he can issue notice up to 31st March 32. Okay, this 5 years. So a case can be opened up to 5 years. And in any other case, if the escapement is less than 50 lakh, then the notice can be issued up to 3 years. In our case, 31st March 30. Okay. But once 148 is issued, now the time limit for 148 is just 3 months more. So, see, there was no time limit for passing an order under section 148A. Okay, we didn't study, there's no time limit. But this time limit can be indirectly provided under Act because Act says that 148 notice can be issued where the escapement is 50 lakh or more up to 5 years from the and 3 months from the end of relevant assessment year. Okay. So 148A is issued, say, on 31st March 32. Then AO has to issue 148 by 30th June 32. So he has to complete his 148A proceedings within this month. And he has to pass 148A order by 30th June 32. Though it's not specifically stated in the Act, but it's indirectly stated. You are with me? Understood? Okay. And if the income escapement is less than 50 lakh, then the time limit for 148 notice is similarly 3 years and 3 months from the end of relevant assessment year. Understood? Okay. Now, notice under section 148 can be issued any time, no time limit, even after 20 years, in consequence of or to give effect to any finding or direction contained in an order passed by any authority or court in any appeal or revision. So the law says if an assessment has to be made to give effect to any finding or direction contained in an order passed by authority or court in any appeal or revision, then in such case, there is no time limit to issue a notice under section 148. AO can issue notice in any time, even after 20 years. However, the above provision shall not apply if notice for such year could not have been made at the time the order which was subject matter of the order was made. Following are deemed to be the cases where assessment is to be made in consequence of. Now, see, it says that if the assessment is to be made in consequence or to give effect to a finding of a order of a court or authority, then there is no time limit for issue of a notice. See, what does it mean? If there is a case came by Supreme Court and Supreme Court said that expense pay is disallowed. It is disallowed. Then, if there was a, say, assessee Mr. X, he in the year say 91, 92 had claimed the deduction of this expense, then AO can now in year 2025 open the case of year 91, 92 on the basis of the Supreme Court judgment because law says, there is no time limit in such case. Okay. We understood. This is logical as well because Supreme Court is a law of land. Now, if an order is passed by High Court, then you can open the case for any year. But High Court order is not binding on the entire India. So in such case, you can open the case only for the assessees who come under the jurisdiction of High Court. If it's an order of a Delhi High Court, you can open the case for the Delhi people, Delhi assessee having jurisdiction in Delhi. But if it's a order of ITAT, then or order of a CIT appeal, then so this provision that notice can be issued anytime is applicable only in case of Supreme Court and High Court. High Court be only when in respect of the jurisdiction covered by the High Court. For the ITAT and CIT appeal, this provision is applicable only in these two cases, which is, see, what happens is that assuming a case goes to the CIT to the ITAT in the case of Mr. A. Okay. And in that decision, what the CIT appeal said is that he said that out of the income which is assessed in the hands of Mr. A, rupees 5 lakh pertains to Mrs. A, the wife of Mr. A. And CIT appeal give this order, give this finding. Now, by this order, it is certain that income of Mrs. A got escaped approved to the extent of the 5 lakh. And therefore, assessment on Mrs. A can be made anytime in pursuance to the order of CIT appeal. Another case may be the CIT appeal in the case of Mr. A may say that rupees 5 lakh pertain to the another assessment year. Then it is certain that the income of Mr. A for such assessment year has escaped assessment to the extent of 5 lakh, and such assessment year can be opened without any time limit. Understood? So for Supreme Court, even the decision of Supreme Court in case of any other assessee, the case of all the assessee in India can be opened on the basis of the Supreme Court. There is no time limit. In case of High Court, the case of only those assessee who comes under jurisdiction of such High Court can be opened. But in case of ITAT and CIT appeal, the case can be opened only in these two cases, where the ITAT or CIT appeal gives a clear finding that this income has to be assessed in the hand of another person. The only in case of such other person can only be opened. Or they give a finding that this income has to be assessed in any other assessment year. Then only case of such assessment year of such assessee can be opened without any time limit. You understood? Understood the logic? If you apply the same logic of the Supreme Court to the ITAT, then the result will be weird. You cannot open the case of the entire India on the basis of ITAT, which doesn't have a jurisdiction over the entire India. Understood? Okay. Let's see it. How is it written? So, law says, following are deemed to be the cases where assessment is to be made in consequence of to give effect to any finding or action contained order passed by any authority or court in any appeal. So what are the cases? When income is excluded from the total income of assessee for any assessment year, then assessment of such assessment of another assessment year shall be deemed to be the one made in consequence. So this is an example where the CIT appeal says that rupees 5 lakh pertain to a different assessment year. Then such different assessment year can be opened irrespective of the time limit, even if 3 or 5 years have elapsed, still the such assessment can be opened for such assessment year because there is a clear finding. Second scenario is where the income is excluded from total income of one person and held to be the income of another person. Then assessment of such another person can be opened. Then assessment of such income on such other person shall be deemed to be one made in consequence of to give effect to any finding or direction contained the said order, if such other person was given an opportunity of being heard before the said order was passed. Understood? So, for Supreme Court, on the basis of Supreme Court judgment, you can open the case of anybody, irrespective of time limit. On the basis of High Court judgment, you can open the case of all the assessee commended of such High Court. But below that, you have to restrict only to the person or to the year, therefore to the judgment of CIT appeal or ITAT. You with me? I hope this is clear. Now, we were referring to the specified authority. AO has to take the approval of specified authority before passing an order in section 148A. And in case of 135A, AO has to take the approval of specified authority before issuing a notice in section 148. Who is specified authority? Specified authority shall be additional commissioner, additional director, joint commissioner, joint director. In the case of what are other provisions? Tax shall be charged at the rate applicable for assessment year for which assessment is made. Of course, assessment for AY 26-27 is made in the year 30-31, then tax rate shall be applied for the year for which the income pertains. Even if assessment is made later on, the tax rate for the year for which the income relates shall be applied. Yeah, this is universal law. In case of reassessment section 147, assessee may claim for dropping of such proceeding. So, if the reassessment has opened, section 147, assessee may say that can it drop, but when? If assessee has not impugned, if not filed an appeal, if not challenged, the original assessment order, either under appeal or revision, and assessee shows that he has been assessed on an amount not lower than what would be rightly liable for, even if income alleged to have case been taken into account. So, if assessee prove that even if whatever the information you have now in your hand, even if that information is considered as an income escaping assessment, is considered that I have escaped assessment, still I have been assessed on much higher amount, even after considering this, then you assessee can approach the AO and ask that you kindly drop me because I have already been assessed to a higher amount. And if AO is satisfied, he can drop the assessment. However, in above case, the assessee shall not be entitled to reopen matters concluded by an order of rectification or the passed by the court. You may also assess or reassess any income other than the income involving the matter which is subject matter of any appeal or revision document of partial. What happened is that, see, assessment section 143.3 or 144 can be made only once for an assessment year. There cannot be a twice a scrutiny. Once a scrutiny order is passed for an assessment year, there cannot be an against scrutiny order. But this is not the case in section 147. 147 can be made n number of times within a time limit. There can be, there is no restriction. Assessee furnished a return of income, scrutiny assessment made, subsequently AO finds some information on which he feels that income escape assessment, he can do 147. Subsequently, he again finds some information for the same assessment year, he can again do 147. He can again do 147. So any number of times he can do 147. Whether the assessee furnished return of income or not relevant. Whether the normal assessment 143.3 has been done or not relevant. Whether done, still 147 can be done. If not done, still 147 can be done. Okay. But what happens is that if once the order is passed, say 143.3 or 147, and such order is under appeal, then AO cannot do the 147 on the same issue which is under appeal. AO can do the 147 some other issue. Say an order is passed under section 143.3 where the Delhi business was assessed and assessee has filed an appeal before the CIT. Now, AO got the information that assessee also has a business in Pune. Now, even though the order is subject matter of appeal, still the AO can issue a notice under section 147 to assess the Pune business. This is called doctrine of partial merger. Partial merger means the order of AO merges in the appeal only partially, only to the extent on the grounds on which the appeal is filed. For all other matters, the AO is open. He can issue a notice under section 147. Okay. Any doubt till now? So we have completed the assessment in section 147. Now we will see very small part, the time limit for completing the assessment. It won't take much time. Let's complete this as well. So section 153 is the one which gives the time limit. So time limit for passing an order in section 143.3 or 44 is 12 months from the end of relevant assessment year. So for me, for the assessment 26-27, the assessment order has to be passed by 31st March 28. 12 months from the end of relevant assessment. Assessment is 26-27. However, if an updated return is filed for this year, then the assessment order can be passed on the basis of such updated return before the period of 12 months from the end of the financial year in which such return was furnished. Then the 12 months is linked with the year of furnishing return of income. You with me? Income under assessment under section 147 can be made 12 months from the end of financial year in which notice under section 148 was served. So the time limit for 147 assessment is linked with the service of notice under section 148. So once a notice is served under section 148, you end that year and 12 months from the end of that year. Fresh assessment by AO or TPO in pursuance of order of ICAI or order passed by CIT in section 263, 264, setting aside the cancellation assessment. See, what happened is that fresh assessment by AO or TPO. So, ICAI, income tax applicator, may cancel the assessment done by the AO and ask the AO to make a fresh assessment. 263, 264 are what? They are the revision. 263 the revision which the CIT does on its own against the assessee. 264 is a revision which the assessee asked. Instead of appeal, he goes for a revision to the CIT under section 264. This is in favor of assessee. So, if in this proceeding the original assessment has been cancelled and AO has been asked to make a fresh assessment, then the fresh assessment shall be made by the AO within 12 months from the end of the financial year in which the order is received or passed by CIT. Receive means the order of ITAT shall be received by the CIT, and in case of 263, 264, the CIT is itself passing the order. Time limit shall be taken from there. The time limit, whenever the order is received or passed, you end that year and AO will get 12 months from the end of that year. So if order is received on 31st December 26, then you end that year, which is 31st March 27, and the fresh assessment has to be completed by 31st March 28, 12 months from the end of the financial year in which order is received or passed by CIT. Okay. Now there's a concept of transfer pricing officer, if you know. So what happens is that during the course of assessment proceeding, if tax officer, assessing officer come across of any international transaction, so he may refer the case to the transfer pricing officer. They are expert in international transaction. Okay. So transfer pricing officer passes his own order, which merges with the AO order of the AO. But there may be a situation where the CIT under revision under 263 or 264 or ITAT may cancel the TPO order, transfer pricing order. In such case, the TPO shall do the fresh assessment and time for the available with the TPO for making fresh assessment is same, 12 months from the end of financial year in which order is received by CIT. See, here it is written fresh assessment by AO or TPO. But in such case, AO also has to modify its order because the final order is passed by the AO only. The order of TPO is given to the AO only. He computes the demand basis the TPO order. So, basis such TPO order, the fresh TPO order which the TPO has made, the AO has been allowed 2 months time from the end of the month in which order of TPO is received by him to pass his final order considering the TPO order. Okay. Now what happens is that, say, an assessment order is passed, assessee files an appeal, and in appeal, the assessee got a relief, the reduction which was disallowed, it has been allowed by the CIT appeal. Now, this benefit, this relief has to be given in the order. So, AO is required to pass an order giving effect to the appeal, which is called appeal effect order. Passing appeal effect order by AO or TPO to give effect to the order passed by CIT appeal, ITAT, High Court, Supreme Court, CIT. Otherwise, then by making a fresh assessment or reassessment. So, what's the time limit? Is 3 months from the end of the month in which such order is received or passed by CIT. So, when assessee files an appeal to CIT appeal or ITAT or whatever, any authority, what they can do? They can either cancel the assessment and ask the assessing officer to do the reassessment, fresh assessment. This is covered here. Or they can give the relief. In such case, the AO has to pass a appeal effect order. Okay. Or they can give a direction basis which the assessment has to be made. Where assessment or reassessment is made in consequence of to give effect to any finding or direction contained in the order. So what's the difference between the fresh assessment on this? In case of fresh assessment, the authority doesn't give a direction. It just asks assessing AO, assessing officer, to do the fresh assessment. But in here, what the authority is doing is asking giving a direction in consequence of which the assessing officer has to do an assessment. And for this, the assessing officer has a time of 12 months from the end of the month. It's not from the year. From the end of the month in which such order received or passed by CIT. As the case may be. Where assessment is made on a partner of a firm in consequence of assessment made on the firm. So if a assessment made on the firm and basis this, the income of the firm is changed. Since the income of the firm is changed, the book profit would change. Book profit would change. The salary would change. The allowance of salary in the hands of firm would change. Once the allowance of salary in the hands of firm would change, it will have an impact on the salary income offered by partner in his return of income. And therefore, the return of income of partner has to be changed. And therefore, an assessment order has to be passed in the hands of partner as well. And for this, again, a 12-month period is allowed from the end of the month in an assessment order in the case of firm is passed. Okay. This impact of change in the impact of profit of the partnership firm on the income of the firm, income of the partner. We discussed this when we were discussing the due date of return of income. You understood? Okay. In all these assessments, there may be a case that AO has to refer the case to a TPO. In such case, whatever time limit is given, it shall be increased by the 12 months. So what it says is that where case is referred to a TPO under section 92CA in the course of assessment or reassessment, the above time limit shall be extended by 12 months. In case of appeal effect order, where it's not possible to AO, we are talking about this 3 months appeal effect order. But there may be a situation where AO says that it's not possible, beyond my control. There are situations or circumstances which restrict me that I pass an order within 3 months. Then a CIT has empowered to allow him an additional period of 6 months to give effect to the order. Okay. Or where the fresh assessment, where the appeal effect order has to be given on the basis of some document which is required to be furnished by assessee. Then the AO will have where order passed by appellate authority require verification of any issue by the submission of any document by the assessee, or requires an opportunity of being heard to be provided to the assessee. Then time allowed to AO for passing the appeal effect order shall be as available with him for making fresh assessment. Then in such case, instead of 3 months, the AO will have 12 months from the end of the financial year in which appealable order is received passed by CIT. It will be deemed that he is making a fresh assessment. So what he's saying is that he's saying that the appellate authority CIT allowed a relief, allowed a benefit to the assessee. But what they say that they give a direction to the AO, he allow the relief only subject to the verification of a document which the assessee submits that it has. So assessee submits that I have this document. On the basis of that belief, the appellate authority allowed the relief to the assessee and said that if you have this document, then the reduction shall be allowed to you. But since the assessee could not produce the document before the appellate authority, so what the appellate authority did is that they give a direction to the AO, only check this document, and if it is there, then allow the relief. Then in such case, AO is not required to do the fresh assessment, but AO needs to give a time to the assessee, and therefore 3 month time is not sufficient. Therefore, in such case, AO will have a period of 12 months from the end of the financial year in which the order of appeal is received or passed by the CI. Understood? Lastly, while computing this time period, there will be some time period which is beyond the control of AO and it got wasted. These are situations we will discuss. You will very logical. You will feel that this time period got wasted beyond the control of AO, and therefore the law says in these cases the time period shall be extended. These periods shall not be considered while computing the above period of 12 months, 3 months, 9 months, as the case may be. What time taken reopening any part of proceeding or giving an opportunity of reheard to the assessing case of change in incumbent of the office of AO. What happens is that if the AO has changed, if AO has transferred, new AO has come, then the assessee may ask for the reheard, and the time taken for this reheard of the assessee is excluded. You know, logical. Period in which assessment proceeding stayed by an order of court. AO issues a notice under section 143(2) and assessee file a writ against that notice, and High Court stays the proceeding. But during which the proceeding was stayed should be excluded from the time limit, because this time limit has been wasted as AO could not do anything. So therefore, this is excluded from the time limit. Period commencing from the date on which AO intimates the central government or prescribed authority the contravention provision section 10 during the course of assessment, and ending with the date on which copy of order withdrawing the approval is received. Understood? We talk about section 10 entities in which the AO writes a letter to central government prescribed authority requesting to withdraw. So the time he writes a letter till the time he receives an order, this period is excluded. Similar is the case for charitable trust or institution. Then comes the special audit. So whatever time is taken in the special audit is excluded. Period commencing from the day on which AO directs the assessee to get the account audited or inventory valued, and ending the last date on which the assessee is required to furnish the report, or where such direction is challenged before court, ending the date on which order setting aside such direction was received. If assessee has challenged the direction and High Court has quashed the direction, then the period from which the AO issue a direction up to a date in which the High Court quashed the direction is wasted, it shall be excluded. I told you for 142A, the law gives the benefit of extension of time limit. Here it is. The period commencing from the date on which you make a reference to a valuation officer and ending with the date on which the report of valuation officer received under section 142A. Similar benefit is not given under section 155A. Okay. The period commencing from the date on which AO receives the declaration 158A ending with the date on which the order 158A is passed. In relation to such, we will do it in such next class. There is advanced ruling. So during the course, when the assessee approach advanced ruling, we will do it in the chapter advanced ruling. The assessment is on hold. So this period is excluded. Then in the case where the AO writes to the foreign government asking for some information which may be relevant for the assessment. So the date from which the AO writes up to the date he receives the last information is excluded. But the maximum period can be the 1 year in this case. There is a provision of GAR. I don't know if you have studied or not. The AO may invoke impermissible avoidance arrangement, the GAR provision. AO may invoke the provision and say that this arrangement is made only with the objective to evade tax. There is no other commercial rationale of this arrangement. But to do that, there is whole procedure. There is an approving panel to which the AO has to approach. That approving panel hears the assessee, hears the AO, and then pass an order. So all this time got wasted, and this time has been excluded. Period commencing from the date on which reference for declaration of an arrangement to be an impermissible avoidance arrangement, IAA, is received by CAT ending on the date on which the direction issued on order rejecting reference is received by the AO. Now the law says, if after excluding all this time, if the time available with the AO is less than 60 days, then the time shall be extended up to 60 days. If the time period available to AO after excluding the aforesaid period is less than 60 days, such remaining period shall be extended to 60 days. Okay. And similar goes for the TPO as well. Now, the last we are doing is notice of demand. What the law says that whenever demand is raised, the demand is raised through a notice, and such notice is called notice of demand under section 56. The only exception is when an intimation under section 143(1) and similar intimation is passed in case of TDS or TCS return. If there is a demand under such intimation, then such intimation is deemed as a notice of demand. And this is a universal law. The demand, whatever is raised, has to be paid within 30 days from the notice of demand. When a tax, interest, penalty, fine, or other sum is payable in consequence of an order passed under the Act, the AO shall serve upon the assessee a notice of demand specifying the sum paid. Wherever any demand is raised, the AO shall serve upon the assessee a notice of demand. But when a sum is determined to be payable by the assessee, director or collector in the intimation issued under section 143(1), processing of return, similar intimation is passed in case of TDS and TCS return under section 200A and 206CB. So intimation shall be deemed to be notice of demand. So if demand is arisen in case of processing of return, then the intimation itself is deemed as a notice of demand. Otherwise, you specifically issues a notice of demand under section 156. But if subsequent under any other law, the demand has been modified, then the AO shall issue a modified notice of demand. With the amount in respect of which a notice of demand has been issued in section 156 is reduced as a result of an order of adjudicating authority under IBC, the AO shall modify the demand in conformity with such order and shall thereafter serve the section notice of demand specifying the sum so payable. And if such order is again modified, then AO shall again modify the demand. Of course, when the order referred above is modified by NCLAT or Supreme Court, the modified notice of demand issued by the AO earlier shall be revised accordingly. So these are very small topics. Today we covered majorly the updating return and the assessment. 143, 144, 147. Do let me know if you have any doubt. I am left with only a very small part. It will take just 2 minutes. We'll complete this and we'll then conclude the class. Okay. So last point is, see what happened is that in case of startup, they issue the ESOP to their employees. And ESOP is taxable and that's salary, and the employee is required to pay the tax. So what happens in case of startup, the amount of salary in cash is far below the amount of the ESOP requisite. So the employee generally doesn't have an amount to pay the tax on ESOP. The tax on ESOP exceeds his cash salary. Because they are startup, so they can't afford much salary payments, so they keep the cash portion low. They give the ESOP to the employees they are joining to them. So what the law gives the leeway? Law says that in such case, the tax on such ESOP can be paid after 4 years. So what law says? Tax on perquisition of ESOP allotted by an eligible startup referred to in section 80 IAC shall be payable within 14 days. 14 days from where? After the expiry of 48 months from the annual relevant assessment year. So whenever ESOP is allotted, is taxable, but tax shall be paid after 4 years, and once the 4 year elapsed, 14 days from such 4 years. Or from the date of sale of such security or shares are made by assessor. But if the assessee has sold such share, then you have to pay the tax within 14 days from the sale of such shares. Or if assessee has ceased to be the employee of the such employer, if such assessee has left that startup, then he has to pay the tax within 14 days from the date he leaves the job of the startup, whichever is earliest. So, in this case, the notice of demand shall be issued only on the expiry of the time period specified herein. Otherwise, the demand shall be raised as per the order. Understood? Okay. So, this completes my assessment except the block assessment, which we will cover in the next class. Do let me know if you have any questions. We can, if there's anything doubt, we can again explain to you. The intent is the concept should be clear to you. Okay. So should we conclude? Or is there any questions? Okay. Thank you. Bye. Yes, sir.